Good morning to all the members who are participating in this virtual seminar on bank audit. Today we have a sessions being organized by SIRC of ICAI. So we have 3 topics being discussed. The first one being red flags and early warning signals for effective audit. To address this session, we have invited CA Sarath Kumar from Hyderabad and his partner CA Lakshmi Rao from Mumbai. And next topic would be on recovery systems, NPA, ARC, DRT, IBC, SARFAESI by CA and advocate Ashish Makhija. He's from Delhi. And the third topic would be on reschedulement and re-phasement related circulars by Vivek, Krishna, Govind from Ernakulam. Friends, in terms of an audit, suppose a client is there and a borrower is there. When a borrower borrows money and is paying regularly, there is no problem for a bank, no problem for the auditor. But once the borrower has some problem, there will definitely be some signals which will keep coming, and that's where the role of a chartered accountant is to understand what are all the signals we are getting. Red flags should definitely be there, early warning signals should be there, and that would be the beginning of understanding what is the issue which probably we can expect from a prospective defaulter. So to overcome that and to understand these processes, Sarath Kumar sir will explain us what could be the situations and how, as a CA, we should probably study the file of a client, a borrower, and see how we can analyze and understand where we land and what is our role in ensuring that we make proper classification. A second situation would be once the borrower starts getting into a stage of defaulting, then the bankers would definitely go for reschedulement and re-phasement, and that's another situation where as a CA we have to see whether they are with circulars of RBI is being followed or not. And the third stage, when actually the party is defaulting, that's when the situation comes where the banker would classify them as NPA, and what are the exit routes out of that, whether they go for ARC or DRT or IBC or SARFAESI. These are the things which, as a chartered accountant, we should ensure we don't get caught in the process, and we classify and comment on those accounts in a proper way so that the RBI doesn't find fault with us, and ensure that we are not in a troubled stage. So this is a broad idea. We thought we'll have a session on these topics, and since we have 2 speakers available, we'll start off with these speakers. We'll invite Ashish Makhija as the next session speaker, and he will also be joining shortly. So on the topic of red flags and early warning signals for effective audit, since we have Sarath sir and CA Lakshmi Rao, I will introduce them briefly, and then we'll hand over the mic to them, and then we'll start off this session. CA P. Sarath Kumar is a chartered accountant and senior partner of Sarath and Associates, a 31-year-old chartered accountant firm. He has 40 years of professional experience, has a degree in law, a certified fraud examiner, and a certified forensic accounting professional. He is a former civil servant. He specializes in financial strategy, restructuring, personal financial management, red flag studies, forensic investigation, and prevention fraud risk management, tracing the diverted funds and hidden assets, benami assets, loan evasion cases, and financial fraud investigations are some of his core strengths. He is a recipient of Letter of Appreciation and Lapel Pin from Secretary General of Interpol. He is a recipient of SC Life Dedication to Vigilance Award conferred upon by the Central Vigilance Commissioner. He has addressed the first, second, and third global Interpol conferences held at CBI headquarters, New Delhi, on the topics of tracing the proceeds of corruption using forensic and financial audit trials and best practices for investigating of companies. He is a member of the Audit Advisory Board of C&AG, AP and Telangana Police and Odisha. He is an advisor to Ministry of Home Affairs on the matters of anti-money laundering and economic crimes. His firm, Sarath and Associates, conducts regular forensic audits, investigation for SEBI, SFIO, Enforcement Directorate, National Investigation Agency, Narcotic Control Bureau, TS and AP Police, and Mumbai Police on matters of financial fraud, money laundering, and economic offences. He is advisor to CBI on regular visiting faculty at CBI Academy on matters of investigation of anti-corruption and economic offences cases using forensic methodologies. He was involved in back-to-back forensic audit investigation of Satyam computer scam on behalf of both CID of AP Police and CBI. He has conducted forensic audit of for CBI on Sharada scam, financial forensic audit on Kingfisher Airlines case, was also handled currently by him for CBI.
Naresh, enough for me. Go on. You can cover Lakshmi Rao and we'll start the session.
I think one last paragraph, which is very interesting, is a regular visiting faculty at various forums of ICAI, Sardar Vallabhbhai Patel National Police Academy, AP and TS Police Academy, AP Judicial Academy, and National Academy of Customs, Excise and Narcotics. In fact, the request, sir, I'm cutting short your introduction. It's in fact a very detailed one, but since he requested, I'm condensing it. Now coming to the his partner, CA Lakshmi Rao, a distinguished member of CI for more than 31 years of experience, senior partner of Sarath Associates, heading Mumbai office. She is carrying out several audits, statutory internal bank audit, investigation audits, certified auditor of World Bank financial projects, CFA, certified money laundering specialist, and due diligence for corporates and FIIs. Experienced in handling 100+ investigations for central government, state governments, investigating agencies like CBI, ED, and other agencies. She is heading a team in providing investigation services and forensic audit for cryptocurrency cases to central and state investigating agencies like ED, EOW Maharashtra, SIT, and NCB. She is a mentor and tax advisor at CA Tax, Digital Asset Professional Tax Solution, and she is active in domain blockchain audit since 2017. And she is also investigating the currency scams of various governments. With this brief profile, I invite CA Sarath Kumar and CA Lakshmi Rao to address on the topic of red flags and early warning signals for effective audit. Over to you, sir.
Thank you very much, Mr. Naresh, first of all for inviting us and a very warm introduction on a Sunday morning. My regular CA colleagues here, we are here before you to share our experiences in handling various cases, including bank audits in various capacities, including statutory central auditors and all. With of course, the challenge we faced always, which you all agree with me, is the statutory branch auditor will have the luxury of 3 to 4 days in each branch. Am I right, sir? At least as central auditors, we have a luxury of quarterly visit. So how to be more effective and efficient within the time possible? Let me cover. Screen sharing. Yeah, is it visible, sir, to you all?
No, sir, not yet, sir. No,
is it visible now?
No, the right below the orange arrow, third button, as you did earlier to stop the screen sharing. Maybe I'll take the rights and give it back.
Right one. Now?
One minute.
Now is it visible, sir? Show
No,
my screen.
Yet,
yes.
No, click on.
Show my screen.
Now visible. Now it's visible. Now visible, sir. Please continue.
Okay. Screen. I am not able to see myself. Basically, I am able to see the camera portion only.
Yes, sir. Yes. Since you are starting sharing a screen, it might be going at the backstage. So
yeah. I'll go back and.
Now it's visible, sir. You can continue.
Yeah. Okay. Sridhar, you give me a printout, or Lakshmi, you can start sharing, or you can start sharing from your computer, Lakshmi. I'm unable to see the screen.
In that case, I'll share it, sir. You just click on next 1 minute.
Yeah. Please.
I'll give you the control.
Yes.
Okay.
Yes, yes.
Now I'll give
Is
you
it
the
okay, sir?
I'll give you the control, sir. You can navigate the screen. You can
Yeah.
see now. You can just you can click on mouse center of the screen. It should be near navigating.
Yeah. I'm unable to.
Yes,
Yes,
you're
now
able
it is.
to. Okay.
Now, overview of the session is changing expectations from SCAs and SBAs and perceptions about auditors from various government agencies. Also, I will spend 1 minute on that. Very interesting observations. Bank frauds, typical modus operandi. Why I'm giving the modus operandi? Modus operandi itself is a red flag for you as a learning curve. You can observe the modus operandi and see whether such scenario is existing while you are auditing the branches. Precautions and practical aspects while carrying out the audit, early warning signals and useful red flags, need for professional skepticism. Sir, I never get tired of presenting this facet of professional skepticism, which has become imperative today. To jump the gun, I am happily married for 40 years, very happy marriage. If still I am getting up in the middle of the night and seeing my messages and switching off the phone when my wife questions me sleepily on a regular basis, my wife, in spite of 40 years of marriage, she has to suspect me of doing something wrong, but not once in a while, on a regular basis. So skepticism comes with the right precaution, not trusting fully, not distrusting also. So way forward also I am going to share with you. Way forward. Next slide. Yeah. Now, perceptions about auditors and CAs. Auditors will detect and prevent frauds. This is expectation somehow from the government agencies also. Our job of audit is entirely different from detecting fraud, but it has come off late from all government agencies that we are there to detect frauds. The audit system itself will prevent frauds. If CA doesn't know, then nobody knows. Therefore, CA is giving clean audit report and sudden discovery of frauds cannot be believed. If a branch audit is conducted by a CA, that means he is certifying that there is no fraud existing in that branch at all. And mounting NPA situation is the perfect example. Banks are subject to many audits, regular inspection, concurrent in IS audit, branch audit, RBI audit, stock audit. All these still NPAs are growing. But who is getting the blame, sir? Who is getting the blame? Only CAs have become the whipping agency. Hence, the perception that without the knowledge of the chartered accountant, frauds cannot happen. I don't agree with this, but unfortunately, even at the highest levels of the bureaucracy and the powers that be, is the perception existing. Then, role of auditors and responsibilities. In the light of the above dynamic changes, the role of chartered accountancy in delivering better services and also combating frauds is assuming significance. Hence, our role is twofold. One, as a statutory central branch auditors, and then other auditors, inspection, concurrent, parana, stock auditors, etc. This is more theoretical portion. Of course, Lakshmi gathered this data yesterday. In half year of 21-22, banks saw 1,802 reported new cases of fraud amounting to 35,060 crores related to advances, and many such cases surfaced in the bank branches audited by the SBAs and which were not commented upon adversely in LFR except in 10 to 15% of the cases. I'm sorry to say. That means where these 1802 frauds reported and the branch audited by the branch auditors, no adverse comments or no adverse notice were drawn in, including in LFAR by the branch auditors of the bank, which is a cause of concern, not only to me at the levels of Reserve Bank, etc. Sir, once again, I crave your indulgence of all my colleagues who are listening to me. I always state this, I am not here to criticize anybody. I am here to share our experiences, including me and Lakshmi Rao, and enable you and empower you to be a better auditor. That's all. Do you agree, Lakshmi? We are not here to criticize. Yeah. These are all large cases: AGB, PMC, ILFS, Nirav Modi, Gitanjali, Kingfisher, Zoom, Rotomac, etc. Just it's a list. Okay. Our responsibilities, Lakshmi, you can cover according to RBI guideline. You can cover this.
So, sir, now presently the expectation of RBI from the branch auditors and the central auditors is to follow the RBI circular, which has been issued on May 7, 2015. Here they have clearly defined what are the early warning signals and how an account has to be red flagged when such kind of red warning signals are identified by bank or by the auditors. Banks have to choose and adapt what are the early warning signals they would want to identify and what they would want an auditor to see and inform them, and they can the list is being given by the RBI. So based on that, the banks do red flag the accounts, and as an auditors, whether we are acting as a central auditor or as a branch auditor, we have to take care that the already red flagged accounts are being properly monitored or not by the bank or the branch, and are there any fresh new accounts where this kind of red flags or early warning signals are visible through their documentation, through their transaction monitoring, or through their security status. So the expectation of early warning signal as per the circular, it has to be tracked at three major stages. That is at the time of pre-sanctioning a loan, or at the time of disbursing the loans, and during the annual review of the loan accounts. So these are the major periods.
Annual review includes monitoring also, regular monitoring also.
Yeah. Annual review and regular monitoring of the accounts.
Yes.
So where any suspicious transaction or documents are being observed by the auditors, it has to be immediately brought to the notice of the bank, or if the graveness of the fraud or the suspicious is higher, then it has to be highlighted to the top management of the bank. So auditors are at liberty to take it forward to the management at various levels depending upon the seriousness of the fraud.
Yeah, my question to many of the friends is the popularly asked question to me is, can the SBA, statutory branch auditor, communicate to top management, that is MD or audit committee directly? Yes, he's entitled to, nothing prevents them, but don't send frivolous complaints. Just I have seen couple of complaints given to audit committee in couple of banks where I have examined. I strongly suspect diversion of funds. I strongly suspect. No, never do that, sir. Do it based on facts, if the facts justify. Yeah, coming to that, to jump the gun, going to the half-yearly data Ms. Lakshmi Rao provided, 1800 odd frauds. Except 10% of the cases, none of the branches are all audited by the branch auditors. None bought out the red flag system in the LFAR or the branch audit report, in spite of the presence of red warning signals. I think I'll cover all those things. To jump the gun here, most important point of red flag missed in many cases commonly is the borrower account is PNPA, not NPA, PNPA. Okay, sir. Then the LCs are issued to certain parties. Immediately within issuance of the LC, within 4 days, the account is regularized by receipt of the funds. When we mapped, this has become a common occurrence in over a period of last 1.5 years. 1 year to 1.5 years. Showing a cycle, whenever account is likely to slip into NPA, couple of LCs are issued. LCs are discounted by the other bank, which you are not aware. But at that juncture, we are aware now when we are investigating the cases. But within 3 to 4 days of subsequent to the LC issue, money is bought back, which is almost equal sum. For example, sir, I give a 1 crore LC. account is PNPA to the extent of 90 lakhs. Okay, sir. Within 3 days of issuing of 1 crore LC, 95 lakh funds are received back into the account to make the account regular. If the branch auditors could have easily mapped these things, which they failed to do, which slipped into NPA, then subsequently declared fraud. When we are investigating, we found that these early warning signals were not mapped, and the obvious red flags, the so-called writing on the wall, are disregarded. Lakshmi Rao, you can cover the other areas of trends
Sir,
in a fast manner, because we have other areas to cover.
Right, sir.
Yeah,
In LC also, I would want to highlight. In LCs, generally they are opened in for the materials that is supplied or the purchase orders of the sister concern or related parties. They are opened and subsequently they are found to be invoked, or such kind of things are also existing. So at the time of audit, auditors are expected to see the LCs opened in whose name. Are they related or are they?
Yeah, to add, Lakshmi, to you, and for what purpose? Okay,
Right.
a chemical company, unless they are going through a civil construction mode, they need not open 1.5 to 2 crore LCs for the supply of steel and cement when there is no expansion. Example I am giving, sir. These sort of things we have observed repeatedly. Go ahead, madam.
So the general trends are already everybody is aware, like project cost inflation, inflated expenses, and creating fictitious bills, or inflating sales purchase, and these are all common trends in the bank of frauds. But to the extent where the borrower is operating more in current account rather than in the CC or OD limits that they have been given, has to be given more importance while conducting the audit, because CC account is expected to have more transactions in that than in a current account. So current account is just for the convenience purpose, but the transactions, if happen through cash credit or OD facility accounts, it is two-way advantage to borrower and even the bank. We can even see the credit summations in line with the sales that they are reporting in stock statements and all. And also the account will not get NPA in as much as the way it's happening now. But when we see in many cases, current account is used in many ways, even to divert the funds. When we investigate, we find, or at the later stage, we find the borrower is not operating the current account, but he is actively operating the other accounts.
Yes.
So this has to be
not TRA accounts.
Not TRA accounts, but other current accounts opened with the consortium members, maybe with members who are other than consortium banks. They are also operating these accounts.
Yeah, the second para is very critical. The second para is very critical. You can throw light here, madam.
So in what we see generally in bank accounts, when we see the CC accounts or OD accounts, we find the debits are more important. That is, what is outgoing is more important. The borrower is paying to whom and who is the beneficiary is what we have more interest in look at, and where the funds are diverted. But what we would want you to see, the credits also be given in equal importance, because credits can happen not just out of the sale realization. It could happen through round tripping or circuitous transaction amongst the accounts of their own group.
Yeah. Very good point. Very good point. Let me add something here. Let me add something very important. Sorry, I'm interrupting you. One important point, I have a list of major debtors. Okay, sir? The money is realized into the credit of my account from my debtors. Am I right, sir? Many a time, at the time of year end, when the account is PNP or something, I am finding suddenly credits into my account from none of the debtors. It is neither unsecured loan, nor realization from debtor, nor share capital induction, but the credit is coming. These type of early warning signals are also have to be mapped very, very critically and carefully. Yeah, go ahead.
So total credit summation and mapping it with the sales directly without understanding the reasons of and the sources of that credit summation may mislead us during our audit. So we need to see, we need to give equal importance to credit entries as well as debit entries in the current account. I mean CC account and OD accounts.
Yes.
So so further, we are seeing stocks which are hypothecated in primary securities are like stocks and book dates. Fraudulently, they remove the stocks in maybe in a 2-3 months time what they have already reported without showing any sales in their sale amounts. They are reporting the stocks and removing those stocks which are already reported 2-3 months before. That means we need to follow the stock statement submitted by the borrower at least for last 3 to 6 months stock statements for the major borrowers or on a sample basis, because that may give the how the borrower is functioning, how his business is running in a last few months. We should not rely only on the last or previous stock statements. Even if we see sometimes we are finding in provisional balance sheet or the audited balance sheet, suddenly certain stocks or certain debtors are being written off abruptly, or they are provided for without even informing the banks, which is a major concern. When we go in a post investigation, when investigation time, we see whatever they have reported in stocks are suddenly been wiped off in books, which an auditor can see and highlight to the bank. So this is more important because that is the primary security that is being offered to the bank for the limits they are exercising. So similarly
I have one more observation here regarding stocks to supplement what Ms. Lakshmi Rao is telling. Though this is not the forum for other audits like stock audits and all that, concurrent audits, in many cases we are investigating now, we found that the company is subjected to stock audit by the bank. The stock auditor has certified that the stocks are existing. Subsequently, when the fraud is declared, it transpired that stocks are not existing for the past 1 year. When we questioned the poor man stock auditor, he said, "Sir, the fees is only 10,000 rupees. Yes, I did not visit. I signed sitting here by taking the data from them within my office." Sir, my strong advice to all my colleagues is, don't accept assignment at a lower price. No problem. It is your choice. Once you accept the assignment, segregate the work and the compensation you are getting. Whether it is a 10,000 fee or 1 lakh fee, you should do full work of 1 lakh worth. This is my strong suggestion to you. Go ahead.
Sir, we have also seen certain cases where the stock auditor is clearly mentioning the issues with the stocks, with the hypothecated stocks, with the book debts. They are rigorously going through their books of accounts and they are highlighting in the stock statement. In spite of that, maybe at the time of preparing the LFAR reports, we are skipping or we are unable to report it in LFAR, because through LFAR only branch auditors can take their points highlighted to the central auditors or to the banks. That is the only medium of communication for the branch auditors. One should take very seriously while drafting the LFAR report. So one has to go through concurrent audit reports, inspection reports, and the stock audit reports, and see the any negative remarks or any balance sheets in any auditor's opinion is negative, or any highlight and matter of emphasis is given, or there are any litigations which have a bearing on the financials, has to be properly understood. Though I understand the time is limited at the time of doing the branch audit, but still at least major cases one should see and use the LFAR for its fullest purpose for it is expected to serve. So from there, the branch auditor's message is being communicated to central auditors, where it will be highlighted at the top management level.
So there are three major areas of focus, sir, while carrying out the bank audit as a CA or SBA. The broad areas are documentation related areas, system related areas, and transaction related areas. Lakshmi, you can throw light on that.
So now the early warning signals, now we are dividing in three methods. That is one, as we already seen in RBI Master Circular, they have mentioned the red flags and early warning signals. So these early warning signals we try to bring in a simpler way. That is related to document related early warning signals and security related early warning signals and system related issues. So document related, when we as an auditor we are handling the branch audits, we have to see whether all the terms and conditions are being followed. Major terms which are being laid down by the bank at the time of sanctioning are being fulfilled or not has to be seen, and then also we have to see that all the documents which are expected are complete and collected, and the latest audited financial statements are there on the records. And friends, we need to have all these in the concerned borrower file. Generally what happens at the time of audit, we don't find or are not given at the time of audit limited number of days that we visit the branches. So we request you to suggest the banks to keep all in the same borrower's files, because they may be having the stock statement, they may be having the documents in their records, but they're not available at the time of the visit of the auditors. But these are all very important for monitoring or even to find early warning signals for us to understand, are there any existence of early warnings or not. First of all, basic thing is that we need to have the information. So information in the concerned borrower's files and accessible to us is equally important. And after seeing this, we need to see whether stock statements are given or are in time, and these are fed in the DP register and in the systems on monthly basis. Generally, we are seeing in banks that the DP is fixed and it is been there for long time. They are not changed.
Not reviewed periodically, as is necessary.
Monthly, it has to be reviewed based on the stock statement, and monthly the DP has to change if it is required based on the stock statement submitted.
The non-updation of DP itself is an early warning signal. Yes. In an account particularly. In our experience, the non-updation, same DP carrying on for 10-12 months itself is an early warning signal. Yes, Lakshmi, go ahead. Go faster.
Similarly, security related, the valuation nowadays we are seeing there is a lot of valuation reports, and based on which in the financial statements also impairments are taking place. The loss is being bottom line of the financials are being hit by the new Ind AS related compliances by the financial statements. So based on this, what is the value of the security offered as on the date of the balance sheet to the bank, and whether it is properly captured or not has to be verified by the auditors at the time of auditing. And any securities which are seen offered for security, and are they charges are created or not has to be seen, and the correct value of the security has to be mapped in the system. Basically, this is more about security and availability of security. If those securities are not available, we can even think of diversion of funds if the securities value is not to the extent of the term loans, for example, are they availed, and the security is not up, asset is not created to the extent.
Now major areas, practical nitty-gritties are critical. These are the duplicate customer IDs is a rampant thing that is existing. Many a time it is intentional, unintentional, but quite sometimes we found the duplicate customer IDs are meant for certain purpose. This is not the forum to discuss. Credit summations of last 90 days are equivalent to interest charge exactly. 90 days from the due date, not 90 days from calendar months. Impersonal office accounts monitoring for any misuse. Recoveries from written off accounts and its accounting also is very, very critical. Recoveries from written off accounts is existing rampantly for various purposes of evergreening the loan, and whether financed for state central government budgeted expenses. Any of the colleagues here who are going to do statutory branch audit and central audit, RBI specifically prohibits financing of budgetary expenditure of the governments, respective governments. Okay, budgetary expenditure cannot be. So the corporations which are borrowing money are rampantly diverting such money for budgetary expenditure, which is patently, grossly violating the norms stipulated by these things. So while doing branch audit, I have seen many branch auditors are so happy to have 1,000 crore rupee advance given to government. They feel it is so well secured, they'll spend half an hour on that and go to other areas. I request you to see the such money is not diverted for budgetary process from corporation accounts, please. And follow-up of already red flagged accounts is important. Any concession on treating account for not classifying as NPA, that is evergreening with the help of the bank also should be frowned upon, should be taken up with the higher level, higher authority. Many times I found a check is discounted on 30th of December and the account is brought into regular. After that, the check is represented 2 to 3 times. Any account is regularized on last penultimate day of the quarter, and see that if by proceeds from the check discounting, see that whether the check is encashed immediately or it is represented 2-3 times. If it is represented 2-3 times, that means the check discounting route is utilized only for evergreening the account. I hope I am clear, sir. Yeah, Lakshmi, you can go faster. Other areas you have to cover in 20 minutes.
So contingent, we need to see if there are any contingent liabilities reported by the borrower been crystallized. If so, that has to be seen, that is been reflected in the CBS and their liability of the borrower in the bank CBS systems. So monitoring the financials submitted by the borrower. Generally what we see many, particularly infra companies where they borrow and the loan proceeds are given in as investments in their subsidiaries. But at the time of giving or investing in the subsidiaries, they are mentioned in the financial statements of the company which the bank has lent. But in initial stages, banks are either ignore or they don't bother to see where the money is being. It is been reported in the financial statements. In spite of that, bank's attention is not drawn. So what happens subsequently when the account gets into NPA, then they realize that these initial funding was gone into subsidiaries companies as investments. And we define it
to supplement Lakshmi's observation. Many a time, suppose what the branch auditor has to do, simply he has to see the sanction appraisal note, whether such investments are captured in the sanction appraisal or not. If they are not there, the investments are a clear case of diversion. Why the banker choose not to comment is a different issue. It will come later, but it's for the branch auditor to comment upon that very clearly.
So as an auditor, how do we see as an auditor that these are diversions at the time of audit? What we have to see is the sanction letter, go through the sanction terms, mainly the purpose for which the bank has financed the borrower. So does it specifically mentions that the purpose of the loan was to even include the investment in subsidiary. If the answer is yes, then there is nothing to report. If the answer is no, then definitely it is to be reported in LFAR. Maybe in future period that could be considered as a diversion on prima facie with a sanction letter. So any audit
Similarly, any audit qualifications, frequent impairment of assets, as she mentioned already, write-off of debtors, create debtors first, then write them off on a regular basis. Once in a while, once in 5 years, it's okay. Once in 3 years, it's okay. If this practice of writing off is going on yearly, it has to be. Increasing unbilled revenues in borrower financial statements, unbilled revenues, critical area. Yesterday night only, I am discussing with my colleague, yesterday night. Frequent use of current account than CD, OD account, as she stated, and use verification in case of project delays, test checking the system calculated provisions for NPA. Very, very critical. CBS will cover now. Audit trail for upgradation and downgrading both. Audit trail is important, sir. Why? Couple of cases we found that inter-office accounts were utilized in regularizing the account and later it was reversed. The branch auditor never bothered to observe that and comment also. Inter-office accounts of the bank wanted to help the borrower. So it is a writing on the wall, inter-office account, say credit aya, nobody bothered from where the credit came from, and the credit is adjusted in the next 10 days, in the ensuing second week of the next ensuing quarter. This is also important. CBS, Lakshmi, you can go faster. After CBS, we have to cover other areas also. We have less time.
In early warning, now RBI is expecting system-driven IRAC norms being implemented by the banks. So we have to more concentrate on the system-related issues as well. Now all is well and CBS takes care is what generally all the auditors, even banks say, this employees say CBS will take care, ye dekh lega, humko kuch karna nahi hai. But this is not the case for the auditors.
At all.
Now
At all.
So now the system is never perfect. One has to see, all also understand that no process is perfect. We should check for the robustness and effectiveness of the system and identify areas where there are system errors and highlight them. Check for exceptional reports. Exceptional reports are to be seen meticulously, and particularly the system related errors. And you can as well do some test checks on the interest calculation, maybe test check on the 90 days interest debits that are being done. Is equivalent credits from the borrower has come in the account, that is equal, that has to be seen whether to see whether system is doing correct or not. And track potential NPA cases and see if there are later regularized with genuine repayment or through circuitous transactions. Check for changes in parameters like EMI dates, because now 90 days is from the date of EMI date, not the 90 days. It's not like January, February, March, so 1st April account gets NPA. It's not like that. If the due date is 5th Jan, it has to be on 5th April, not on 31st March. So this has to be addressed. Auditors has to take care of this particular change that RBI has done recently. For all the major cases, compare sanction terms and conditions and how they are captured in the CBS while creating the data. Check how system is capturing the stock statement data for calculating DP. As we explained, it is, many a times they are not changed on monthly basis. Check how security value is captured based on financial statements submitted periodically. So further on system-driven issues, focus attention on ad hoc sanction and temporary permissions and how they are finally addressed. The reversal of incorrect entries, generally what we have already explained little earlier. If we are focusing on credits in the current cash credit accounts or OD accounts, we think that the money has received from the borrower, but these credits could be which are very serious in nature are: one, if the credit is coming through impersonal or office accounts, generally they call it as. If it is happening from the credit from that account, one has to go through the reason why the entry has come through impersonal or office accounts. Second is, generally when they make a mistake in passing a debit entry, bank creates another entry reversing the wrong entry, wrong debit, hence now credited. So that credit system will never know that it is due to incorrect entry, correction of the incorrect entry being now rectified. But system doesn't understand this. So that credit has to be nullified while calculating the 90 days credit equivalent to 90 days debit for the interest and EMIs. So one has to nullify this.
Auditor has to personally verify without depending on the system. System doesn't demarcate between inter-office credit or a personal credit from a corporate account. So this is very, very critical. And asset status should be borrower wise and not facility wise, of course. Need to verify all the invoked LCs of each borrower are also linked to CBS and to give correct outstanding. Many a time this link is missing. Simply what I do, I delink it to CBS, then CBS shows a healthy picture, whereas the real data will be something different. That's what happened in the PNB case. There is no handshake between the SWIFT message and the CBS. SWIFT is giving LCs. LCs are maturing, whereas CBS is not capturing. That happened in PNB case. So check for the duplication activities carried in and out in multiple customer IDs are existing for the same borrower. There is a possibility that a single borrower has been allotted 2 customer IDs. This can be verified by taking customer_ID details fields from the CBS, which gives the non-financial details of the borrowers like address, PAN card, Aadhaar, etc., which will enable you to cross-verify in the event of any doubts. In the event, you need not verify this for all cases, sir, due to paucity of time. Where there is an early warning signal for you, you get a doubt. A simple command like this will give you 90 cases in one go. Okay. Then audit plan and documentation, Lakshmi, we need not spend. They are all better than you and me. Okay. So please don't ignore concurrent audit reports which you mentioned. LAPR importance you mentioned. Devote more attention toward borderline red flag cases. That is very important. Okay. Certification. Precautions while carrying. Yeah, this you can throw light here. Yeah.
While performing branch audits, emphasis should be on checking the potential red flags as mentioned in the RBI circular. So my friends, please, I request you go through the particular RBI circular. Please download the circular and have the red flags and early warning systems listed out there and see if they are existing any cases, so which you can report it to the branch. And mapping between revenue and connected assets while recognizing income. Generally, it happened in Punjab National Bank Nirav Modi case.
Well, I will take 60 seconds here. It is very, very important, which is missed out. The LC discount revenue, the income realized from LC discounting is taken as income into the account, but the concerned LC is not taken into the account, surprisingly. Had anybody matched the income and the asset connected, suppose I am telling you I have house rental income, do you verify the existence of the house or not, sir? You are happily accepting the house rental income as an entry, but not bothered whether house exists or not, then the fault lies with the system in capturing it. That is what happened in PNB. It is rampantly noticed by us in various entities we are encountering in various investigations and regular audit also. Yeah.
Next very important thing is due diligence required while checking group company entities in the same bank. Do cross check. So question is, how do we know who are the group companies and who are the related entities or associate entities? If we go through the financial statements submitted by the borrower, one can go through what the names of the people who are key management personnel, and one can see the associate or the related parties or other companies and map to whom these payments are happening. If they are having the account in the same bank, one can see in the, suppose they belong to the same group, our deduplication, what we called customer IDs we called, if the directors are having the same, and it has to link to the group. So we need to see this, because once we the account falls into NPA, we see the money is lying in some other account, but still the account is NPA. Probably the money is diverted to sister concern, having that money in the same group company, in the same bank. In spite of that fact, the account is the borrower is classified as NPA. Maybe even banks will not be knowing at the time of slipping the account as NPA. So auditors, we request you, please go through this. We are also trying to identify where you can check and where you can report them to bring to the notice of the banks. So exchange of information.
That's okay. That is precaution rather than red flag.
Right.
Audit documentation also, audit engagement letters and all is okay. Precautions, audit planning, tech savvy, ideally should be mix of both. Yes, this is important. Audit planning, old generation versus tech savvy team. Ideally, there should be mix of both. Notion that everything is done by CPS, we have emphasized on that already. Checking the changes in the system parameters is rampantly being done. Sometimes unintentionally also. With good intention, genuine mistakes are also happening. Some recently, I think we encountered a place where the borrower, the account of sanction date is taken as 1/1/1950, because that is the extreme parameter which was given in the programming. 1/1/1950 is the borrower. That is 9 years before I am born. Unintentional mistake, but the entire calculations changed because of that. Okay, utmost attention on ad hoc sanctions, etc. should be taken. Red flags, yes. Now, Lakshmi.
So red flags, what we need to look into: additional loan given to existing borrower during the quarter ends, debiting the disbursement directly to arrears of current loan or against the interest. Transactions through personal office accounts needs a special attention. New loan released to avoid an old one to become an NPA through sister concern is evergreening, which already discussed. Loans released by branch, irrespective of various, subject to clauses in the sanction letters, legal opinions, valuation reports. These needs more attention. Huge mismatch between turnover shown in the financial statements with the credit summations in the loan account. If we see the stock statement, as we discussed already, these things can be addressed. Huge transactions in the current account instead of CC/OD accounts. Large irregular account is made irregular just before reporting quarters and slipping back into irregularity in the subsequent periods. Old debit entries in one loan account is reversed by transferring the amount from other OD account or loan account with new date, with or without including additional borrower of the loan.
These are all practical things one encounters in the thing.
Right. Next, transaction passed by staff beyond powers. So what is staff powers? You can ask for the authority matrix. Sanction authority, they have written in the bank manuals. So you can call for and see what is the powers. So in exceptional reports, if they sanction or authorize beyond their power, it is been highlighted in exceptional reports. You can go through that.
Particularly in our experience, Lakshmi will agree, we observed this happening more in non-fund limits rather than fund limits. They take care not to meddle with the powers delegated under fund limits. Non-fund limits, rampant usage were there. Again, PNB case, Gokulath Shetty.
Best example is advances and deposits from two same borrower sister concern group at the year end. Non-obtaining of confirmation of documents from consortium leader. Generally, this is the regular thing that happens. Non-obtaining of allocation of limits in original and permitting operations based on fax or other modes of confirmation. Friends, please take the document for such kind of communication through mail or fax. Have those on record. Non-registration of charges with ROC or undue delay in the same also is a serious concern for security.
Yes. Deccan Chronicle is a classic case where the charges were purportedly filed by the company and copies given to banks. All banks happily accepted and filed them. Ultimately, it transpired that such charge creation letters are false. No banker, though they have access to MCA website, which could have been cross-verified in 5 minutes, did bother to verify. Later, it went into fraud of about more than very huge sums.
Next slide, please.
Yeah.
So next slide, we'll go
Yeah,
to.
I'm trying. Yeah, 1 minute. Yes. Yeah. Professional skepticism. Yes.
So professional skepticism, sir.
Go ahead, please.
It's an attitude that includes a questioning mind and critical assessment of audit evidence, and it is essential to perform the effective audits. But so friends, here attitude including questioning mind means doesn't mean you keep questioning the bank and keep questioning the central auditors or keep questioning the top manager. It's about understanding point and relevant document is available, audit evidence is available, or is justified or not for the point raised. That has to be seen before even going to top management or to the central auditors. Professional skepticism requires an ongoing questioning. The auditor should not be satisfied with less than persuasive evidence because of belief that management is honest.
That is borrower management. Borrower management's priority to get the maximum DP with minimum these things. So they may cut some corners, they may not cut some corners. So you need not distrust them, and you need not trust them fully also. You have to strike a balance. Yes.
The deficiency in the professional skepticism is observed in many investigations. This is not confined in our country alone. This is there across the world. So more particularly in fraud cases, the very characteristic of fraud calls for greater exercise of professional skepticism when considering the material misstatement due to fraud.
I'll throw a little light here. I specialize in studying human nature. All fraud or mismanagement is committed by humans. You need not be skeptical in all the cases. When there is a early warning system, when there is a red flag you perceive as a red flag, or when there is an inconsistency in the presentation made, total consistency is not there, then you should be a little more skeptical. The degree of the skepticism purely depends on the judgment of the auditor on the field by taking into account and consideration the field realities and early warning signals. I hope I am very clear. Yeah.
So, sir, you can carry on.
Yeah, the way forward will be comprehensive audit planning with detailed checklist, including intrusive tests for system controls, is essential with actual verification, because we are going to depend and believe the system so much. Verify the system first. Your support system, suppose you have a car, speeding car, will you check whether the car can reach 120 km speed as advertised in the newspapers in 1 second or 2 seconds, or will you check the brake system first? Brake system is the essential control system. Check the brake first, then the speed comes next. Otherwise, you may be achieving the speed without the brake, your speed of no use, will be finished. So,
sir, I would add here one point, sir. The RBI now is giving more importance on system-driven NPAs, and system-driven IRAC norms should be implemented by banks. So for us, when we are certifying so many certificates, we need to see whether the system is being fed the correct data or not. Otherwise, the data given is like our old thing, GIGO, garbage in, garbage out. If wrong data is given, our reports are wrong, we are certifying wrong numbers. So system is a system where we have to see whether the parameters and the data entered is right or wrong. So that will ensure the system controls majorly.
Yeah. Then the detailed justification explanations where certain observations are dropped when compared to earlier versions. This is very important, sir. I write an email to the branch when I am departing for additional data. Due to paucity of the time and pressure from the zonal office and all that, I will conclude my audit report without these things, which is not an appropriate thing. You have to clearly state that in the absence of data so and so, you have to mention that fact at least in LFAR, if wherever you feel appropriate, in the manner you feel appropriate. Otherwise, your risk is not covered. Today the expectations are so high, the time is so limited, the pressures are so much. You should work like a superhuman. How do you work like a superhuman? By keeping all your faculties alive and by doing proper planning, you can succeed. Absolutely, there is no worry at all. We are very jovial and positive in nature. What all we are sharing with you, we are only giving precautions for to be more efficient. And now the third question comes. The responsibility of seeking information while carrying out the audit should not be a static one. We observed CCP going on into the seeking information. Cut, copy, paste. CCP, whether the borrower account is a construction or a pharma company or some other thing, I have a static CCP model of seeking information. Send the mail. So you ask a wrong question, you get a wrong answer. You ask a right question, which is tailor-made for the situation, you get a right answer. Similarly, emphasis on adherence to RBI compliances like IRAC norms, as Lakshmi mentioned, red flag studies, identification of fraud trends, etc., without any compromise. This should never be compromised, sir. Very, very, very highly, the so-called earlier days of the romanticism associated to audit are no longer existing. It is a tedious and time-consuming and mind-applying work rather than a routine work wherein we have to go. We are going to see which restaurant is good nearby, which temple is good. Nowadays, I observed this practice in the last 20-25 years. The moment we go to branch audit, the branch manager will say, sir, I hope you are religious, such and such famous Shiva temple is there, when shall we go? So afternoon from 11:30 onwards, sir, we have 3 exceptionally good restaurants, sir. Which South Indian, North Indian, Chinese, Italian, which one you want to go? All the while, he wants you to spend minimum time on the audit on the data perusal. He wants you to be present in the branch, but not to do your work properly. So devote your time. Don't allow yourself to be distracted. Emphasize the adherence to RBI compliances. Read them beforehand. Most important I observed is, we are all good in our own work. The juniors who are preceding us to the branch level are not oriented and trained and guided properly. We are going for a day normally, in my experience, maximum 1.5 days. The junior team who is sitting there, they are becoming the final bosses, which should not be the proper way. Again, sir, I am not here to criticize. I am only here to improve the efficiency. And finally, be abreast with the current trends in raising NPAs due to financial frauds by borrowers and other mismanagements, and learn from them and apply in your day-to-day work. I think we are open for a few questions. Yeah,
I would want to add one point, as you already know, that whenever any fraud occurs in bank related frauds by any borrower, first question asked by the investigators is the branch is under audit? Who is the auditor? They will not ask who is the manager, who is the bank. They'll ask who is the auditor, what is the firm name. They'll not ask even who is the signatory. So the bosses are always to be more alert than the staff. So that needs to be kept in mind while doing the audit.
I think we succeeded in orienting you all in the topic given to me by Mr. Naresh Gelli. The credit goes to him. We were both really busy in certain 2-3 major cases. He chased us, and I hope we succeeded in orienting you and empowering you in a better manner. Any questions I can take, Naresh? Ashish ji is already available online.
Yeah.
Naresh is on mute. Yeah.
So maybe 1 or 2, sir.
Yeah, please, please. Most welcome.
1 minute, sir. I'll just take
Or else, sir, can I get these questions instead of then mail to you, sir?
Yeah. We will answer them leisurely. We will answer them leisurely. Ashish ji is online already. And thank you all. Thank you for inviting us. Naresh?
Yeah. Sure.
Thank you. Thank you,
One
sir.
second, sir. So, yes, madam. So I thank CA Sarath Kumar sir and Lakshmi madam for sharing a lot of experience and a lot of information about areas where the chartered accountants, when they go to branch audits, to be alert with reference to red flags and early warning signals, with a lot of examples. So thank you very much, Sarath sir and madam, for coming and sparing your valuable time and addressing members on a Sunday. Thank you very much.
Thank you. Namaskar. Thank you, sir. Ashish ji, namaskar.
I'm just waiting for him to turn on his camera.
Members, we have next session, and the topic is on recovery system, NPA, ARC, DRT, IB, and SARFAESI. So, with reference to this topic, CA Advocate Ashish Makhija ji will be addressing. Maybe 1 second, he should be joining. He was already on the screen.
Yeah.
We will wait
He's
for him.
already on the screen. I saw him. Ashish ji is
Yeah.
there. Yeah.
Morning, Ashish ji. Namaskar.
Yeah, namaskar.
So before I hand over the mic to Ashish ji, so I would like to briefly introduce Ashish Makhija ji. Ashish Makhija is a leading practitioner in insolvency and corporate law matters as a managing attorney of AMC Law Firm, a firm headquartered in New Delhi. He bears top credentials in corporate laws, insolvency and bankruptcy laws, corporate litigation and advisory. He was standing counsel for the official liquidator attached to High Court of Delhi for 6 years, handling many large cases of corporate insolvency and liquidation. He regularly appears before Supreme Court, High Courts, NCLAT, NCLT, insolvency, bankruptcy and corporate laws, and arbitration matters. He's been retained as interim resolution professional, liquidator appointed under IBC, a committee of creditors, promoters for handling proceeds during the corporate insolvency resolution process, liquidation, legal matters, legal advisory, and forensic audit, among others. Academically brilliant, Ashish Makhija was awarded gold medal in CBSE for obtaining 100% marks in mathematics. Ashish Makhija is a fellow member of the Institute of Chartered Accountants of India and also Cost Accountants of India. He holds 2 Masters of Law degrees, one from India, another from USA, and is pursuing PhD in law from Emory School of Law, USA. He is a distinction of being World Bank trainer on corporate laws, and he is sought after faculty and spoke exclusively on subject of corporate on professional interests, including independence of directors, insolvency, bankruptcy code, to name a few. He is an adjunct faculty for Indian Institute of Corporate Affairs and the Ministry of Corporate Affairs, Government of India. Ashish Makhija has authored 14 books to his credit on the subject of insolvency and bankruptcy and corporate laws. He is also an avid contributor of articles in journals and online portals of repute. He served as a member of monitoring group of ICAI, Institute Insolvency Professionals. He is on the advisory board of IP Foundation, a trust to facilitate and address issues in the field of insolvency. He is also served as a member of a drafting group of the high-level committee formed by the Ministry of Corporate Affairs for amending acts of 3 professions, which are CA, CS, and ICAI. He is a special invitee to Corporate Laws and Corporate Governance Committee of the ICAI in the year 2017-18. A member of e-corporate business working group formed by the Ministry of Corporate Affairs, Government of India, for introducing e-forms under the Indian Companies Act 1956. He has significant corporate board experience and has served as an independent director in Shipping Corporation of India, Caterpillar India Limited, and various public and private limited companies. He is a keen golfer and has won the coveted hole-in-one trophy in the year 2015. With this brief profile, I invite Sri Ashish Makhija ji to discuss on the topic of recovery systems, NPA, ARC, DRT, IBC, and SARFAESI. Welcome, sir.
Thank you, Mr. Nareji. I think it's my delight, and I'm really thankful to Southern India Regional Council, and also Mr. Nareji for inviting me for this particular seminar. And I must appreciate the efforts of the SIRC to conduct seminars in a well-organized manner. Particularly, I can see the attendance. There are more than 400 people who have joined out here. Well, friends, it's time for the bank audits. And I was listening very intently to the other panelist, Mr. Sarath Kumar, and he explained in a very interesting manner how to go about the bank audits and all, and what precautions the auditors need to take. Well, very interestingly, he mentioned that the branch managers will generally like to divert your attention so that you are not able to concentrate on the audit. I think that's one of the good takeaways which we can learn from here. Now, friends, insofar as the recovery process is concerned, well, we all know that there are guidelines for declaring the account as an NPA, which is the accounts which are to be declared. So once those accounts are declared, then definitely there is a recovery mechanism which is put in place, because the bank now feels that these accounts have become non-recoverable and the effort should be made. Now, there are two processes. One is that whether to go for an OTS or not, the one-time settlement, because if the bank feels that, look, we will not be able to recover full amount, so therefore there is a process of one-time settlement which can be entered. But nowadays, insofar as the OTS are concerned, the banks are also going slow on the OTS. The Insolvency and Bankruptcy Code, which came into being, now they were directed initially that you must use this particular act so that the resolution process can start for the corporate debtors, for the companies, for which those who have borrowed money from the banks. Now, before we go to the IBC and understand those provisions, let us also look at that what exactly was the process prior to insofar as the companies are concerned. I'm not talking from the bank's point of view, but let us also discuss about the history of the corporate recovery or revival. Friends, all of us are aware that prior to Companies Act 2013, we had Companies Act 1956, and there are a lot of provisions which were there relating to the winding up of the company. That means if a company was not in a position to pay its debts, the company could be wound up under Companies Act 56 or Companies Act 2013 later on. Well, this was one of the very drastic features, that if the company is not able to pay any of its debts, so it goes for a complete winding up of the company. Now, this was drastic steps. So what happened in between, that SIC Industrial Companies Special Provisions Act 1985 was introduced, where the attempt was to be made for recovery or revival or rehabilitation of those particular companies, which have become SIC companies. So the definition of SIC company was that if the 100% net worth is eroded. So this was an act which brought in the constitution of BIFR, Board for Industrial and Financial Reconstruction. Now, the BIF, I mean, any company which was a SIC company, they had to make a reference, and one of the lead bankers were appointed as the operating agency, and they used to work with the promoters, and then they were coming out with the revival or the rehabilitation scheme. So this was one of the process which was there. But over a period, now insofar as the recovery of the bank's dues is concerned, now we have even today we have these two laws. that Recovery of Debts Due to Banks and Financial Institutions Act 1993. We call it as RDDB Act. Now, why this act came into being? This act primarily came for a very simple reason, because if in order to recover from the banks, the recovery they had to go to the civil court and file a civil suit. Now, you know that how much time does a civil suit takes, and then kind of the evidences which are required to be submitted. So the shorter process, what we call it as a summary process, summary procedure, was introduced by way of RDDB Act, where DRTs, debt recovery tribunals, were established. So now the banks, instead of going to the longer process and going to the civil courts, now they used to file their recovery dues before the DRTs, debt recovery tribunals. But of course, this process also became little slow. The recoveries were not fast. So then the banks were empowered with very drastic power in 2002 through SARFAESI, securitization and reconstruction of financial assets and enforcement of security interest. So let's understand what is this act. The particular term which has been defined in this act is security interest. So if you have any interest, that means a bank has an interest in a security, that means it has a charge over the particular asset, then it can be enforced. And this enforcement under this act can be done without the judicial intervention. That means no court is involved. So the banks were not required, even if they have the security interest with them, then they need not go to the DRT, and they can invoke SARFAESI, the provisions of the SARFAESI Act, and they can take over the assets which are charged to them. That means what we call it as security interest, and those could be sold and their money could be recovered. So this was one of the powers which were given to them so as to expedite the recovery. So now, of course, at a branch level, you may not be required to verify all these aspects, but at a head office level or a central level, definitely now these provisions are to be seen, their legal requirements, the legal audits, the legal cell, the legal policies, all those aspects are to be seen, whether steps have been taken for recovery, whether SARFAESI have been invoked or not. So all these steps have to be taken, have to be seen in that context. So in any case, even at a branch level, if the accounts are NPA, now I think it is definitely you see with their responsibility to see whether the legal actions have proceeded further or not, because timely legal action is also very important in these particular circumstances. So in SARFAESI Act, two notices are sent. Section 13(2) notice is sent, and then 13(4) notice is sent. After these two notices, then the bank is entitled to take over the assets of the company. I mean, whatever they are charged with the banks, and then they will be in a position to auction them or sell them and recover their dues. Now, besides this, as I mentioned, that there was provision in the Companies Act also. So all these acts were existing simultaneously. So we had the SIC Industrial Companies Act. So if any SIC company, they will have to go before to BIFR, resolve kind of you see, make an attempt to revive the company. If it is a failure, then it goes for winding up. Otherwise, there was a provision in the Companies Act that if a company is unable to pay its debts, and the amount was very low at that time, it was only 500 rupees. Later on, it was increased to 100,000 rupees. But the point is that if the company was not in a position to pay its debt, it used to face winding up. Now, that was not a good idea. So therefore, in 2016, Insolvency and Bankruptcy Code was brought in. Now here, what we are trying to do is that instead of winding up the company straight away, we are making an attempt to resolve the insolvency. So earlier, what we used to call it as that revival and rehabilitation, friends, that is now equivalent to insolvency resolution, because inability to pay debts is, the word has also changed. The phrase, instead of inability to pay debts, nowadays we use it as default. So if any company has committed a default, and default could be any single rupee, default is not equivalent to the NPA. Default could be any single one installment, two installment, or whatever amount is not paid. So that can be considered as a default. So due date has come, the amount becomes payable, but it remains unpaid. So therefore there is a default. So the moment a company comes under a default, there is a possibility that any financial creditor can approach the NCLT and can start the CIRP process, which is known as Corporate Insolvency Resolution Process. So this is the new change which has come. But let me tell you 2-3 things. Number one, inability to pay debts has become a default under the IBC. And the another important aspect is that the trigger point for the CIRP is the default. So unless and until the company commits a default, and of course it is relevant only for companies and limited liability partnerships. Till now, these provisions of IBC have not been made applicable to partnership firms. So please consider that aspect. So insolvency and bankruptcy court process, friends, is not, please understand this, is not a recovery mechanism. And I'll show a few judgments of Supreme Court which clearly indicate that. But prior to that, now there is another aspect which is related to this. Now, IBC is a umbrella law now on insolvency, which means that now the entire insolvency and bankruptcy of the corporate world, of the individuals, now they are covered under IBC alone. So even individual insolvency is also covered under IBC. So earlier we had, not earlier, rather I would say that still we have Presidency Towns Insolvency Act, and we also have Provincial Insolvency Act of 1920. So why the two acts were required for individual insolvency? The two acts were required, very simple. The first act, which is called Presidency Towns Insolvency Act, the provisions were applicable to residents of the presidency towns. And 3 presidency towns were there, as we know: Bombay, Calcutta, and Madras. This act was applicable to the residents of these 3, and Provincial Insolvency Act was applicable to the rest of India. Now, under this, if an individual commits a default, now this is very interesting, you see, because there you will find that when the bank loans are given, generally they are guaranteed by certain personal guarantees, and personal guarantees are given by the directors, their relatives, and other promoters. So the question which is very important is whether the bank guarantee has been invoked or not. See, if the loan becomes NPA, the recovery mechanism also includes that action must be taken against the guarantors also, personal guarantors also. One thing I would like to clarify, that the bank need not recover the money from the principal borrower first. It has the option, my dear friends, that it can recover money from the personal guarantors also. So this is also one of the important aspects. Anyhow, the IBC is also applicable to partnerships, but right now it has not been made applicable. And for individuals also, it has been made applicable in a very you can say limited manner to the personal guarantors of the corporate debtors. So this was the preamble of the IBC, that to consolidate and amend the laws relating to reorganization and insolvency resolution of the corporate persons, partnership firms, and individuals in a time-bound manner for maximization. So the idea here is not recovery. Idea here is to resolve the insolvency so that, and that too in a time-bound manner, for the maximization of value of assets of those borrowers, the companies or limited liability partnerships, and so on and so on. So friends, this is the layout of IBC, because IBC, understanding IBC also becomes very important, and because the actions would be taken by the banks under IBC also. So this is when the act was introduced, there were around 255 sections. And now, of course, we have 282 sections because the act has been amended every year after its introduction in 2016, and new sections have been added thereafter. So today, it stands with 282 sections and 12 schedules. It's an interesting act, but this is the helicopter layout of the IBC. It is divided into 5 parts. And part number 1 talks about, that's a preliminary part, which has only 3 sections, talks about the applicability and the definitions, general definitions which are there. Part 2 is relevant for the insolvency resolution and liquidation for the corporate debtors. Now, there are different chapters like a CIRP process, which will start. And the CIRP process is when the company comes into CIRP, one of the insolvency professional, he takes over as the resolution professional, IRP or the RP, and then he definitely tries to revive the company, tries to bring in the resolution plan so that the company, the insolvency can be resolved. And if that attempt fails, then definitely the company is going to go to the liquidation. So this is the next chapter which is there. So these are divided into different chapters. And then in part 3, it deals with insolvency resolution and bankruptcy of individuals and partnership firms. So here also there are few processes. In company format in CIRP, the 2 processes are the CIRP process and the liquidation process. But in case of the individual, there are actually 3 processes: fresh start process, insolvency process, and then bankruptcy process. So if the company, if the person is not able to resolve his insolvency, then of course the person will be declared as a bankrupt. So those are the things which actions can be taken by the banks under these particular provisions also. And part 4 deals with the regulators. That means it contains the regulatory provisions relating to IBBI, relating to insolvency professionals and insolvency professional utilities, in agencies and information utilities. So these are general sections. And then of course part 5 deals with the miscellaneous part. Now, let us understand what the Supreme Court has mentioned. They say that liquidation is the last resort. That means the attempt should be made to resolve the insolvency of the company. Now, this is what exactly I was mentioning earlier. Here also there is a landmark judgment of Supreme Court, that is Swiss Ribbons Private Limited. Now, they say that what is interesting to note is that the preamble does not in any manner refer to liquidation, which is only availed as of a last resort. That means if there is no resolution plan or resolution plans submitted are not up to the mark. So those are the issues which you have to consider. In resolution plans, see, let us look at one of the important aspects which are there. There is a settlement mechanism in a bank, and then there is a revival mechanism for the corporate debtors, for the companies or the borrowers. Now, settlement mechanism is that there could be a settlement. There can be a settlement through OTS. There can be a settlement with the promoters at any point of time, even after the start of the CIRP process. So these are the possibilities of the settlements which can take place. Now, if the settlement is not possible, of course, there are provisions in IBC also now that a settlement, once the CIRP starts, then these settlement can also take place, but it requires 90% voting share of the committee of creditors. Now, settlements are possible, but what are the modes of revival under the IBC? Let us look at those. These are very important aspects. So as I mentioned, that the modes of revival are that it is CIRP. That means the company is under CIRP, under the insolvency resolution process, and how that company will be revived. Now, the question which can come at many times is that once a resolution plan comes, it will involve a haircut. Supposing the bank has given a loan of say 100 crore rupees, somebody comes, the resolution applicant comes and he files a plan and he says that instead of 100 crores, I'm going to pay you only 60 crores. So 40 crores is considered as the haircut. So now in the books of the banks, obviously this hit has to be taken because instead of 100 crores, now they're accepting or they're getting 40 crores or 60 crores. So rest could be the haircut. And then another aspect is extremely important, that even when the company is under liquidation, then the business of the company can be sold as a going concern. And third possibility of revival is under Section 230 of the Companies Act. That means any promoter or any creditor files a scheme of merger or amalgamation under Section 230, that is also possible during liquidation. So these are the modes of revival, and the company can also be sold as a going concern, as I mentioned, when the company is in liquidation. And there is also another provision in the IBC now, that sale of a business of the corporate debtor as a going concern. So not only the company, sometimes the business can also be sold as a going concern. So these are the possibilities, and the regulation 32A of the liquidation regulations very clearly indicate that the purpose is maximization of value of the corporate debtor, that is the company. That should be the objective. So when we are selling the company as a going concern, because if the company comes into liquidation and you start selling the assets in part, then you are not going to realize too much of money. So therefore, it is always advisable to sell the company as a going concern. So in that case, what happens once the liquidation has got started, company is sold as a going concern, then liquidation will be definitely will be closed, and the money is definitely paid. So there are few judgments of this is a Hyderabad NCLT, because this company was sold as a going concern in liquidation because CIRP was not successful. So the question was, during CIRP, a lot of reliefs can be taken by the resolution applicants. And whatever order is passed by NCLT, once it approves the resolution plan, it is binding on all the stakeholders, including the banks and the corporate debtors. Now, the question arose was that if the company goes into liquidation and somebody comes and takes the company as a going concern because it is sold to him, now whether same kind of relief can be given to them or not. Law is not very clear, but this judgment very clearly says that NCLT is definitely empowered under Section 60 to provide these kind of consequential reliefs. So here it was mentioned that prior to the e-auction date, whatever claims or liabilities were there, then e-auction purchaser will not be held liable. So this was one of the judgments, which initial judgment which was there. Later on, of course, Mohan Gems and Jewels NCLT principal bench held that no, this is not possible. We cannot pass an order like this. But the matter went to the appellate tribunal, and they have actually upheld that liquidator has correctly followed the process. That means the corporate debtor company can be sold as a going concern during liquidation process also. So this was one of the judgments which was there. Now, and they have also mentioned that the Bankruptcy Law Reforms Committee has considered that particular item, that it can be sold as a going concern. So the only aspect which needs to be considered is that whether it will be whole unit versus individual parts. And in fact, in Gujarat, NRECO Kolkata bench directed the liquidator to sell the company as a going concern, and then if that process is not successful, then it should undergo a liquidation as per Chapter 3. That means that is there. So, and now if we look at the company sale of a company as a going concern, it is primarily the time and cost effective manner, because here there will be a single buyer who is taking over the company vis-a-vis the multiple buyers. And the reasons were for sale as a going concern were captured in ArcelorMittal judgment also, that if there is a resolution applicant who can continue to run the corporate debtor as a going concern, every effort must be made to try and see that it is possible. So this was also one of the aspects that the company must be continued. The operations of the company must be continued also, even during dissolution. So therefore, dissolution, they say, in liquidation, dissolution is not the sole objective. But at the end of the day, it is the company must be sold as a going concern. So these are very important, effective provisions which actually try to revive the company. That means an attempt is made that the company should revive rather than survive, rather than company going into liquidation. So these are very important provisions which must be looked into it. Let me take you to one of the aspects of going concern. Friends, the provisions to sell the company as a going concern during liquidation was not a part of the IBC initially. This was only of the judgment of NCLAT, Y. Shivram Prasad versus S. Dhanpal, which said that first attempt should be made to sell the company as a going concern. So they identified that these are the steps which are to be taken, right? So they say that first you must try to compromise, or you must do that. In case the process fails to sell the company as a going concern, then the last stage will be, that is the liquidation. So the liquidator was also asked to follow that kind of a process during this. Now, this is some kind of a data which is taken from IBBI's website, that liquidation number of cases which have been closed is 153, and the companies have been dissolved in 142 cases. Sale as a going concern has happened in 6 cases, and compromise and arrangement schemes have been approved in 5 cases. So therefore, very minimal effort is being taken, but most of the companies are going towards the dissolution route. But at the end of the day, the attempt has to be made to revive the company. Now, what are the factors to be considered? Now, supposing the sale as a going concern has to happen, then liquidator has to decide based on the prevailing market conditions, investor interest, status of the assets, and type of the business of the company. So these are very important factors which a liquidator must consider this. Of course, because in Dhanpal judgment, the NCLAT has said that first section 230 must be explored. Second step, sale as a going concern. Then the company should go into liquidation. Nothing of this sort was written in IBC. So therefore, in one of the judgments of Supreme Court, that has mentioned that the need for judicial intervention or innovation from the NCLT or NCLAT should be kept at its bare minimum and should not disturb the foundational principles of IBC. Because in IBC, the attempt is to be made for the CIRP, and it also says that once the CIRP is not successful, then definitely it has to go into the liquidation. But if you start adopting different processes, because this process was not mentioned, later on, of course, it was brought in as a part of the act itself. So otherwise, this was not a part of the IBC earlier. Now, friends, looking at the circumstances, that what exactly is to be seen. See, as an auditor, when you're doing, you see the bank audit. Now, what are the aspects which need to be considered? Now, what I will say is, just give me a moment. Let me stop this presentation now.
So it was stopped and you have again reshared it again.
Sorry, is it stopped or continued?
No, it's continuing, sir. You stopped for a while and then you have started it again.
Acha, okay.
Now it's stopped. Now it's stopped. Now you're only videos visible.
Okay, right. So, friends, what I want to mention is very important, that as an auditor, now you have to ensure, because you see, these are legal matters. Now, when there are legal matters are there, they are dealt by the law department, and the risks which are faced by the banks are also the legal risks. So the legal risks are extremely important. So first, you have to ensure while doing the bank audit that the documents right? They are maintained in a proper manner. Because if the documentation is not correct, the bank will not be able to recover its money. So documentation starting from the agreement, and then the other important aspect which we have seen is the limitation. Now, you know that the limitation for recovery of money is 3 years. So therefore, the bank must take some proactive action within a period of 3 years. It can't wait for a longer period. So some action must be taken. And in case they are not doing it, then they must obtain an acknowledgement of debt or liability. Now, all the cases which are coming before IBC nowadays, when the case is filed, what is the first stand or the objection which is taken by the promoters? Now, the first objection which is taken by the promoters is that this is time barred, because they have not taken the acknowledgement of debt or liability which is there. So some people say that we will rely on the balance sheet, but balance sheet of course will be considered as an acknowledgement of debt. But in many cases now, in Supreme Court has also said that supposing the promoters or the company is mentioning the amount in the balance sheet, but later on in the notes to accounts they are disputing that amount, so therefore then it will not be considered as unequivocal acknowledgement of debt. So the banks have to be really careful. So it is very important that the legal documents which have been obtained, now that must be in order. Otherwise, at the end of the day, banks will not be able to recover the whole money which is there. Then the banks issue a loan recall notice. Then recovery and securitization notices are also issued. Newspaper advertisements are issued. Then many times the banks are obtaining symbolic or physical possession. Both those things are possible. And whether they have filed cases before the DRT or not, and whether they have initiated insolvency proceedings in tribunals or not. So these are also one of the few of the important aspects which you must ask them. Because and let me tell you, legal team of the banks, generally they are maintaining a tracker for all the legal course cases. They are maintaining it court wise, date wise, otherwise it will not be possible to keep track of it. So legal tracker is being maintained, and after the each hearing it is updated. So this is one of the online legal tracker systems which are updated close to the real time. These are very important aspects which are to be considered. So now the auditor also needs to coordinate with the legal team to get a updated status on all the pending cases which are either filed by the bank or against the bank. Now this is extremely important for the auditors to do that. So the discussion with the legal team will also bring in, of course not at probably at the branch level, maybe at the head office level, it will also help in quantifying the amount of the contingent liability, because you get it only from the legal cases, and what kind of provisioning requirements are required. So provisioning is very important, which is to be provided in the books of accounts. And then another aspect is relating to the frauds. Now, in most of the cases in the banks, and in fact, there is an RBI study also, which says that banks, once the account is declared NPA, most of the frauds are actually discovered or unearthed or reported only at that time, not prior to that. Because something goes wrong, the account becomes NPA, and then the bank starts examining or investigating, and then they find that, oh, this is a case of a fraud, either by the promoters or in connivance with the banks or whatever, the bank staff. And then they start filing the FIR, they also file criminal cases, and then they keep on monitoring those things. So the provisions have to be made against the loss due to such frauds. So this is also very important, that non-credit related frauds, that appropriate provisions are also made by the banks. Now, as far as the auditors are concerned, what they need to do: number one, they must see that the bank has an updated legal policy in place. whether and which has been reviewed periodically or not. So this is one of the important aspects. Two, the banks do have the panel of the advocates, but whether due diligence for empanelment of the panel advocates is being done or not, whether the panel is also being reviewed periodically, evaluation matrix are whether they are being framed or not. So that is also one of the decisions which the bank have to take, and the auditors have to see that. Then documentations which are required for each loan facility which is established is the responsibility of the auditors to see that. Documentation is definitely reviewed, and then of course whenever the regulations change or the new guidelines come, the documentations also keep on changing. And as I mentioned earlier, the tracker of the legal cases is there, which is maintained court-wise, amount-wise, stage-wise, and then it is updated post the date of the hearing, because whenever the hearing takes place, then they also undergo a change. And the classification of those cases, right, that is very important, between probable, possible, and remote, because at the end of the day, the contingent liability or provisioning is to be done in accordance with AS 29. So this is also very important, that classification of the legal cases should be done between probable, possible, and remote, right? What is the possibility of recovery, whether it is probable or whether there is a remote recovery which is there. And then we also have to make provision for the legal liabilities, and we have to arrive at a figure of the contingent liabilities for the court cases. And definitely it is done on the evaluation basis, what are the success probabilities of this. And sometimes it is always a good practice, of course, at a head office level, that an independent lawyer who is engaged in a various legal cases, and he also gives a confirmation. So independent person is engaged and he gives a confirmation about the legal cases, because rather than only depending upon the bank's data, so some outsider is appointed, an expert is appointed. And adverse issues are to be noted in the legal audit if they are not properly addressed. So this is also one of the important things which is very crucial for the bank audits. And then of course legal policy. See, I would always say that get a legal policy of the bank, because this is very important. And the other aspect which I have already emphasized is the documentation. So where those documents are being kept. So number one, first, whether the documents obtained are in order or not. That's very important. And we need to see that they are properly filled in and they are properly signed. This is very, very important. Two, whenever these documents are signed, then who is having the custody? That means filing and custody of the loan documents. It must be in order. They must be in the safe custody. And supposing a movement takes place, so because the documents are traveling from the branch to some other place or to head office or to zonal office, then those movements should also be recorded. And nowadays, of course, the scanning facilities are there. So it is a good practice to have all these documents scanned, because this becomes an easier thing, and no one is in a position to tamper such documents. So this is also very important. Then supposing legal risks have to be identified, and high risks, you see, have to be noted, they have to be considered. And the legal opinions are also, you see, obtained. Then sometimes there are adverse courts judgments do come. So in that case, opinions are reviewed and when seen whether the legal opinion was correct or not. Because at the end of the day, one adverse order against a bank can impact the recovery in other cases also. So these are the few things which must be taken care of it. In fact, if any legal opinion is sought from an advocate, now the auditor's responsibility is to review the same from the angle of the financial implication or any compliance related aspects which are aligned there too. So this is extremely important, and the auditors have to consider the legal opinions as because we also have SA 620, which talks about using work of an auditor's expert. So those have to be taken into consideration, that how far you can rely upon the expert's work. So these are few important legal aspects for recovery. So let us recapitulate what we have discussed. Once the account becomes an NPA, definitely the attempt is to make recoveries. So for recovery, the banks can enter into an OTS as per the guidelines. Of course, if there is an OTS which has been entered, you must see whether it follows the guidelines. It follows the parameters which have been fixed by the board of that bank. This is extremely crucial because you may notice some frauds also there. Then if the OTS is not possible, then whether the banks have filed recovery suits or not within time, because there is a time limitation for filing of that, or whether the bank has approached the insolvency for the CIRP of that company. So either this or that, or both the actions can also be taken, right? The DRT action has to be taken, and simultaneously the banks can also start CIRP if they wish to. So if the company survives, or somebody else and takes it over, obviously the bank will get back its money. Otherwise, for recovery, they will have to go to the DRT, they have to get a decree, and then they have to get the execution of the decree. So that is the process of recovery. And then SARFAESI action, which is without any judicial intervention. The banks are entitled to take over the properties which are charged to them. And one more aspect which is important is, if the bank has got a charge over the property of the company, now as an auditor, we must make sure that the charge is registered with the registrar of companies. Because let me draw your attention to section 75 of the Companies Act, which very clearly says that if the charge is not registered with the registrar of companies, then it is void against a liquidator. So if the company comes into liquidation, the liquidator sells the property, and once it sells the property, realizes the property, it will have to make payment in accordance with the waterfall mechanism which is given under the IBC section 53. And we know that secured creditors like bankers, they get the topmost priority after the CIRP cost or the liquidation cost. So they get the topmost priority, of course, along with 24 months workman wages pari passu to be paid. But there could be a problem. If the charge is not registered, and it is clearly mentioned that this charge is void against a liquidator if it is not registered. So then what does it mean? It means then the bank's amount, instead of becoming secured, it can be categorized as unsecured, isn't it? So therefore it could become a problem because it is void against a liquidator. So those issues can come up. So it is extremely important that in case of a company or LLPs, the charge must be registered with the registrar of companies. So these are very important aspects. Now, if the banks has already started proceedings against a SARFAESI, and in the meantime, the company comes under CIRP, that means under IBC, whether the bank starts it or any other creditor starts it, it does not matter. The SARFAESI proceedings will not continue. And in fact, even the DRT proceedings will also come under a stay. This is known as moratorium. That means once the company comes under CIRP, there is a moratorium. Neither a new suit can be filed, that means no fresh DRT proceedings can be started, or if any proceedings have been started, now they cannot be continued. So this is one of the important aspects which you must consider. And secondly, the SARFAESI proceedings which have been undertaken by the bankers, they will also come under a stay. No proceedings will continue under SARFAESI once the company comes under CIRP. So as an auditor, we must take notice of that. We must take it with a pinch of salt. If the CIRP is going on, then of course the other things come to a halt, whether they are DRT proceedings, whether they are SARFAESI. So all these will come to a halt. Therefore, today the banks are actually taking a call whether to really start the CIRP or not, because we have seen over a period of time that CIRPs may be successful, but largely they have not been very successful so far. But it takes time. In many cases, these CIRPs are pending for 2 years, 3 years, and even more than that also. And the resolution plans which have been filed, now they are also pending for approval with the adjudicating authority for a very, very long time. So these are certain aspects where bankers are little wary nowadays, and they do not want to pursue you can say the process of CIRP, and they are going on different footing, that is DRTs or OTA settlement. OTS, they find it better. But the difference between OTS and CIRP is this, that OTS is done with one banker or say 2 bankers or consortium or with financial creditors. But in CIRP, when a plan is approved, it is approved for all creditors. That means including the financial creditors or operational creditors or others. So this is extremely important that you must look at these provisions. And in fact, I must also clarify that even CIRP proceedings have to be started within the limitation period. And the limitation period is 3 years from the date of occurrence of the default or probably the acknowledgement of the liability. So this was all about the recovery process, and in the context of how the auditors need to approach on the legal documentation or other things. So I hope I've been able to convey the message, and I hand over the proceedings to Mr. Nareshji now.
So thank you very much, sir. Despite coming back from US, you gave us time and shared a wonderful session today, explaining the members how to be prepared in terms of various modes of recovery, and in particular IBC. I'm sure this session would help the members to take care of this aspect of the audit. And it's very nice of you for coming and sparing so much valuable time, sir. Thank you for joining, sir. Thank you very much.
Thank you. It is my pleasure. Thank you so much.
Friends, we have the next session. The topic is on reschedulement and refacement related circulars. With reference to this topic, we have invited CA Vivek Krishna Govind. He's from Ernakulam. So before I request Vivek to address the members, I would like to briefly introduce a very interesting profile. CA Vivek Krishna Govind is senior partner in Verma & Verma Chartered Accountants with more than 20 years of experience in various areas of audit, taxation, and management consultancy. He is qualified at the CA exams with the highest marks from the state of Kerala. Also qualified a Certified Information Systems Auditor conducted by ICAI, USA. He served as the chairman of Ernakulam branch of the ICAI in 2010 and 11, and during which year the branch was awarded All India Best Branch. He held the position of President of Kerala Management Association during 2017-18, and is also served as the chairman of Young Indians, a sister organization of CII for the year 2015-16. He was nominated to the top 50 youth icons of Kerala and has represented India at G20 Youth Summit at Istanbul in 2015. He is also a chartered member of TAI Kerala and has served as the chairman of SICASA of ICAI for the year 2007-8 and 9-10. He served as the president of Rotary Club of Cochin Downtown and has held various leadership positions in Rotary District 3201. He served as the vice president of Kerala chapter of ISACA and has been nominated member of Kerala State Council of Confederation of Indian Industry and was convener of CII via Inspiration Leadership Summit. He served as a visiting faculty at and associated with various premier management schools in Kerala, and has been a council member of CanCure Foundation, which provides aid to cancer patients. He has won district level and state level table tennis tournaments and is keenly interested in music, movies, books, and cultural activities. With this very brief profile of Vivek, I invite Vivek to address the members on the topic of restructuring and reschedulement, refacement, related circulars. Welcome,
Thank
Vivek.
you. Thank you so much, Naresh ji, for first for inviting me, giving me the opportunity, and also for the very warm words of introduction. You've been a friend for many years, and it's a pleasure for me to be here and to share this forum with you. Certainly would have preferred to be in a physical room, and hopefully very soon we will meet at one of the ensuing events. I'll directly get started. We are at 12 noon on a Sunday, so I should ensure that I keep my time. I'll move straight into my topic, and the topic that is a very interesting couple of sessions we've had this morning on, the manner in which this whole seminar has been structured is also very interesting. Early we start with the early warning signs, and then we have a session on reschedulement, restructuring, etc. And then thereafter, what happens when the accounts go bad, distressed. And I think it's been, the order in which the sessions have been planned is also very interesting, and I'm sure there have been a lot of takeaways for all of us from the first two sessions. And let me move straight into the topic given to me, which is about something which is of great concern for the economy and for great concern for the banking sector as a whole, which is the restructured advances. And during the course of the next probably 50 odd minutes that I will speak, I will cover the prudential framework for resolution of stressed assets, which came out in June 19, the resolution framework for COVID-19 related stress, and some of the important circulars which have come in the last couple of years. Also touch upon the recent clarifications, the November 12, 21 and the February 15th, 2022 clarifications related to the prudential norms, which are very, very important for us from a bank perspective when we commence our audit soon. And if possible, if time permits, just a few case studies of some interesting situations where we've seen how the accounts go bad, which have resulted in restructuring. And these are some of the important circulars. The topic that has been assigned to me is to cover the important circulars. So definitely, I will ensure that all the 6 circulars which have been released by RBI over the last 2 to 2.5 years, I will try my best to cover that to the extent possible. And thereafter, the case studies can be taken up if time permits. Now, what is restructuring? Now, this is the definition which has been given by RBI. Restructuring is an act in which a lender, for economic or legal reasons relating to the borrower's financial difficulty, grants concession to the borrower. Now, what we must keep in mind is that restructuring may involve modification of the terms, alteration of the payment period, the payable amount, the number of installments, the interest rate, rollover of credit facilities, the sanction of additional credit facilities, release of additional funds, and enhancement of the existing credit limits, settlements, and the list is exhaustive. So typically what we find is sometimes when we do the branch audits or when we are handling the central audits of the banks, the bank will make some change to the terms and they will try to tell us that this is not restructuring. This is just a term. We've only extended. So we've only given 1 more month. We've only extended it by a year, or we've only given some concession here, or we've just given them some additional facility. It's just temporary. It's only for 20 days to tide over a problem, etc. These are things which which will be explained, and it will sound very convincing to us. And but what we must keep in mind is that restructuring definition is very, very exhaustive. The list that is mentioned in the circular is only it's only certain items which are to be mandatorily included, but that does not mean that the other items which would result in a change in terms or an extension of period, etc., are also to be construed as restructuring. So this is very, very important, because we see that quite often when we hands-on, when we are at the bank audits, this is what we see. Accounts which have already been restructured once will be given some add-on facility for a few more days, or some extension of period given, and they will say, no, sir, this is not restructuring, sir. This is already we have given a restructuring package. This is just a little bit of time given or some facility given. But we must understand that will result in a second restructuring, which obviously will mean that it has to be classified as an NPA. So the understanding of what restructuring means is most important before we get into the circulars and the terms and conditions and the resolution plan and all of that. Before we get into all of that, the simple meaning of what is restructuring is we need to keep our eyes and ears open when we go for a bank audit, because it may have been done sometimes in a very simple manner, making it look as if it's not even a restructuring, it's just some add-on sanction given for a facility, etc. They will try their best to oversimplify it. We heard the morning session speaker, Mr. Sarath, articulating about how the bank managers would try their best to ensure that we do very minimum audit, and they'll be happy to take us around the city and give us a tour about at all the pilgrimage sites nearby, etc. And so the intent is that the audit team spends as less or as minimum time as possible in the branch. So we must also be aware that we are under stress in terms of time, 2 days, 3 days, 4 days to complete the audit. So we should ensure that the critical aspects are not missed. And this is one very, very important aspect which has created a lot of problems for the banking sector. So restructuring is something which is very, very important. I'm just trying to stress that before I get into my detailed presentation on that. And RBI has introduced several proactive, systemic controls over the last few years, especially after the AQR was done, asset quality review from 2015 to 2018, which resulted in a large number of accounts having to be classified as NPA. A lot of these accounts which were restructured under various dispensations and kept in cold storage or deep freezer had to be taken out once the AQR review was done by the RBI team. Dispensations were given by RBI itself, and they withdrew all of that, suddenly resulting in a huge spike in the NPA. I'll talk about that in my next slide. Thereafter, several steps have been taken to ensure that the asset quality improves, and CRLIC is something which is a data repository which is very useful. In fact, when we do the central audit of banks, we make it a point. CRLIC reports have to be data has to be fed in by the banks on a monthly basis, and that is usually done within 15 days after the end of a month. So when we go for either a quarterly audit or an annual audit, if let us say I'm doing the Q3 audit of December, by Jan 15th, the CRLIC data would have been uploaded by various banks. And what is important is that it shows us the classification of an account or an advance in other banks. So this is something which is very useful for us, because it may be a very good account here. We may not have any history of this account showing any kind of stress in our bank or our branch. But then we see this in CRLIC, and you will see that this is an NPA in 8 other banks or 10 other banks, or it is a red flagged account in some banks, or it has even been flagged as a fraud account in some other banks. So that's something for us to look at. We must understand that does not mean it will automatically become an NPA in our bank. That's not what I'm saying. Each bank, we have to look at the operations in isolation, and if it is performing well in the bank which you're auditing, fair enough, accepted. But it's something for us to look at an account with greater depth, because CRLIC report is usually a signal of an account. I mean, an account which is flagged as a bad account or a willful defaulter account in CRLIC by a bank. Obviously, there are issues in the account, irrespective of how it is performing in your branch. So it may be advisable to flag that, or to make at least to write a comment about it in the branch LFAR or in the central LFAR or in the if you're a central auditor, we make it a point in all our audit committee presentations which we make to the board when we are central auditors. There is always a slide of accounts which are standard in the bank which we audit, but which are classified as NPA or red flagged or fraud in another bank. We always ensure that we put up that slide just for the information of the board, saying that we have operations we verified here, it's all right, but this is a problem account in some other bank. And a lot of steps have been taken, proactive steps by RBI, and let's hope that the situation improves over a period of time. And as I said earlier, the problem really started when in 2015 the AQR process, which was a very different kind of audit which was done. At that point, we were auditors of State Bank of India. We were the central auditors at that point when this AQR happened, and we saw the kind of accounts, the large number of accounts and large accounts in terms of the size of the advance also going bad, and some of the accounts which have been reported subsequently in media, and which a lot of discussion has happened due to haircuts and IBC settlements, etc., including Videocon or Bhushan or SR, etc. Many of these things were had to be classified during that phase of AQR, and in PSU banks, the gross NPA level was below 5% before the AQR, and that there's a huge spike, went up almost 3 times to almost 15% in public sector banks, and for the entire banking system as a whole, it was somewhere around 11.5% in March 18. That's how bad the situation was after the dispensations and all other what do I say, the accounts were frozen, deep freezer or cold storage, whatever we may call it, of restructured accounts. They had to be pulled out and brought back into the mainstream, and immediately once the dispensations were cancelled, it would be classified as NPA. Subsequently, the situation improved over a period of time between 2018 to 2020. If we study, the GNPA is down to 8.3, 7.3, etc. But as all of us are aware, last couple of years, the impact of COVID has been rather shattering on the economy. Yeah, I spoke about this point about the GNPA of PSB and on the effect of COVID, thereby resulting in greater stress. As per the RBI circular, again, some of the indicative items which result in restructuring, 6 or 7 items have been mentioned in the circular. Again, it's not an exhaustive list, but typically these are the cases which we would see. The borrower's cash flows are assessed, found to be insufficient. Credit facilities which would otherwise be categorized as non-performing unless these concessions were given. Existing exposures showing great stress, which could lead to, or sectors which are showing stress, which could lead to classification. Default, obviously, as per prudential norms, if a default is there, then the classification of that or the restructuring of such accounts where a default is there. And borrower which is not in default, but where clearly as per the track, it's obvious that it is going to land in a default somewhere, and non-compliance issues which have resulted either in delisting or threat of it being delisted, etc. These are all causes which are indicative signs of financial difficulties which could result in restructuring. I'll move on to the specific points. It's almost 12:15 now, and the next 30 minutes or so I'll try and talk about 5 or 6 of the specific steps which have been taken by RBI in the last 2 to 2.5 years. Starting with the resolution of prudential framework for resolution of stressed asset, or what they call the FRESA, framework for resolution of stressed asset, which came out in June 2019. In fact, it first came out in Feb 2018, but there were some problems with that, and the famous Dharani Sugars case of Supreme Court struck that down. Subsequently, a fresh prudential framework was drafted, and that has been implemented from June 7th of 2019, keeping in mind various points which were noted in the Supreme Court judgment. And one very important thing which has come with this prudential framework is this concept of SMA. We always had standard asset and NPA, and actually nothing in between. Even when we do the branch audit or central audit, we would always have to write in our audit report that we see a lot of stress, but there is no definition for such accounts other than to just call it a stressed account. So we would write all about the stress and close by saying that the account seems to be undergoing stress, and this needs to be closely monitored by the branch management or by the senior management, etc. would be the closing line. But now thanks to this SMA, I'm not getting into this. I'm sure there have been sessions on these aspects, but nevertheless, it gives us an indication. An account which 0 to 30 days is SMA 0, and or 1 to 30 days technically. 31 to 60 days is SMA 1, and 61 to 90 days is SMA 2. And what is followed for this is typically the prudential norms itself. Any of these categories of stress as per prudential norms, which has continued default for more than 30 days. SMA 0 is okay, so to some extent is all right or acceptable, but SMA 1 and SMA 2 accounts are looked at very closely whenever we go in for the audit. That's the list we start with. There are issues there. Needn't be that these are going to be NPAs, but that's probably because by end of the quarter steps are taken to recover or to ensure that the default which is persisting has been regularized. But nevertheless, it's a pointer that these are the accounts which are an account which is not even there in SMA in the SMA category can generally be seen as an account which is performing well, at least from the operation side. There could be other issues, there could be fraud or other sectoral issues or sister concern transactions or evergreening and all that. These could be there, and such things could be done to keep it out of the SMA. But otherwise, assuming that it is an honest borrower, and that borrower is not in the SMA category, by and large we can treat that account is fairly all right. And all of this again, are reported to the platform, so we can look at it and understand an account which is performing well here, but if it is an SMA2 in some other bank, it's also an indication that this could have a problem here. And the framework talks about an RP in a resolution plan. I'm not going to get into the technicalities of the RP etc. in detail, but it's a good structure that has been created, the June 19 prudential framework. And there are certain conditions for implementation of the RP. Now, one important point here is that in this particular prudential framework, what it says is that unless there is a change of ownership, if a restructuring is done, an account has to actually be downgraded to an NPA status, to substandard to start with, and thereafter moving with the time-based classification. That's one thing in this prudential framework, which is different from the other circulars, which I will discuss about later, wherein in the other circulars it's clear that you can retain it as standard, and a restructured account can be retained as standard. And in the COVID restructuring, in fact, even an NPA account, if it is restructured according to the conditions specified in the circular, it can even be upgraded. It's just what the circular says. I'll come to that when I speak about that. But here, even in change of ownership, there are certain conditions prescribed. For want of time, I will really not be able to discuss about all the conditions in each of these circulars. But the important ones I'm bringing to the screen here. Now, plans not involving restructuring where there or change in ownership, the borrower, what are the conditions to be looked at? Borrower is not in default with any of the lenders as on the 180th day from the end of the review period. Any subsequent default after the period shall be treated as a fresh default, resulting in a fresh review. Next, plans involving restructuring and change of ownership. Again, the completion of all necessary documentation, including execution of necessary agreement between the lender and borrower, creation and perfection of security are completed by all lenders in line with the RP implemented. New capital structure and or changes in the terms of conditions of the existing loans get duly reflected in the books, and borrower is not in default with any of the other lenders also. And plan involving lenders exiting the exposure by assigning the exposure to third party upon extinguishment of entire exposure, and plan involving recovery also, it's the same upon extinguishment of the entire exposure. Now, these are things which we'll have to look at very critically. On screen, it may be 3 or 4 bullet points here, but when we pick up a case and when we are looking at the implementation of the RP, it's a tedious task. You must understand that, read the file, understand and ensure that the terms of the RP are in line with what is promulgated in the framework. Understanding that there could be gaps because the language used by each bank, they will not use exactly the language of the circular. Each bank will have their own way in which these documents are entered into. But as an auditor, we must ensure that we look at it in great depth and understand, and that it's clear. And if there is a problem with the implementation of the RP, then we need to flag it, we need to report it, and if necessary, necessary action needs to be taken, including classification and further downgrade, etc. Things which we will have to look at. And moving on, additional provision is required when this is done as per this particular RP. All lenders are required to make the additional provision if a viable plan is not implemented within the stipulated timeline, or where the lenders have initiated recovery proceedings. In case implementation is delayed beyond 180 days, then an additional 20% needs to be done. Lenders, the banks, have to create an additional provision of 20%, and delayed beyond a year or 365 days, as the circular says, an incremental 15%, which means 35% provisioning is required if the RP is not implemented beyond 365 days of entering into the implementation plan. So we must keep this in mind. Right, so that's regarding the first framework that I spoke about. Now the next framework is the COVID-19 related. There are multiple circulars here over the last couple of years. As all of us are aware, the whole economy has been facing great stress, and in fact these dispensations which have been given, this resolution framework and the restructuring packages which have been offered have greatly helped. Apart from all the additional facilities which have been granted like ECLGS and all that, I'm not getting into that. It's beyond the scope of my topic. But apart from that, one really good move which the RBI and in turn the government has done has been to be compassionate about the borrowers who are suffering as a result of the COVID stress, and ensuring that these accounts can be retained. Otherwise, these are honest borrowers, and it's only because of the stress. So this framework has certainly proved to be very, very useful. And what I will cover, two of these circulars in tandem, which are the framework, COVID-19 framework, which came out on 6/8/2020, read with the notification on 5th of May. Now here what has happened is that RBI has brought out what is actually a principle-based resolution plan. Unlike the other case, this is more of the good part about this particular framework is that there will be no asset classification downgrade, unless of course there is change in ownership and some of the other conditions are not being complied with. Otherwise, the borrower gets to retain the status in which the account has already been in. And so largely, most of these accounts which come under this are accounts which are in standard or were in standard, which would have otherwise landed in SS category or D1 or D2, and sometimes when there is once it moves to doubtful, if the security valuation is or security is also not available, then much larger provisions are required, and sometimes full provision is required, etc. All of that need not be done if it is done according to the conditions stipulated in this prudential framework for COVID stress. Not applicable for certain cases. Now, farm credit, loans to primary agricultural society, agriculture, which are for on lending to agriculture, exposure of lending institution to some of the sectors, financial sectors, government, etc., to HFCs, and the loan sanction to own staff. These are kept out of the purview of this particular scheme. Now, what are the basic conditions? Now, why are we talking about this? Something which came out in 2020 and early 21. Now we are sitting in March 22. Why are we even talking about this? Isn't this period over? Is a question which can come. No. What we must keep in mind is these accounts which were restructured based on these circulars are all now going to be under our purview of audit. So we must keep this in mind. Large number of accounts which were given this benefit of these restructuring packages at that point in time are now going to come under our audit. So it is important that we take a fresh look once again. Last year the branch auditor could have been another auditor, or the central auditor could have been another auditor. So when we look at these accounts, it is also important to see whether the originally whether it was done properly and in compliance with the said circular. If not, directly you need to reclassify it. Simple. You should not accept, or we should not accept something saying, no, this is done as per the circular. It is accepted by the previous auditor. And so that term is not ending now. It goes on up till, you have time till September 22. Moratorium is given. 2-year moratorium is permitted as per resolution framework 1 and resolution framework 2 of COVID. So 2 years is there. That period has not started. So why do you want to revisit this whole issue? These are all, all done, and detailed review has been done last year by the auditor. So you don't need to take a relook at this. Could be an argument which you may face, which we may face when we go for the branch audit or even at the central audit level. But let us not accept that explanation and without verifying facts on our own. So it is important that we once again revisit these circulars which came in 2020 and which have come in 2021. It is important that we take a relook at it We take a relook at all the accounts concerned, and in many of these accounts, according to the terms of the original RF1, the term would have ended. So these accounts are likely to require a downgrade in the audit period when we are now auditing. We are going to look at 21-22. So all these accounts which were given a dispensation or a moratorium or an extension for as part of the package, these accounts are all now going to be having to face the heat during the course of our audit. So it's important that we understand these circulars and understand the dispensations which have been given, and understand the conditions based on which this COVID-related framework has given an added time or an added interest benefit, or an added extension of facility, or extension of time to repay, whatever it is that has been given to these accounts. It is important that we revisit it again. And what are the basic conditions? Standard but not in default for more than 30 days as at 1/3/2020 should continue to be standard till invocation. Resolution must be implemented within 90 days to individual borrowers and 180 days in other cases. There are multiple lending institutions. Resolution shall be invoked if lending institutions are representing 75% of the value and outstanding 60%. This is also important. So each condition is important. We have actually seen cases where it seemed like everything is all right and done, but then when you look at it and go in depth, we see that 75% or 60%, as the case may be, it's not verifiable. It needs to be verifiable also. They cannot tell us that it is already done. 75% of the lending institutions having 60% of the lending institutions having representing 75% of the value. Has to be verifiable. So we need to get hold of documents wherein we are able to verify that is done. The intercreditor agreement shall be signed within 30 days from date of invocation in all cases involving multiple lending institution. If not, it is lapsed. So all the documentation will be there. But if the ICAI is not done within 30 days, and if we are not able to see the document, then the whole the restructuring falls flat. So we need to verify these. We should not just discuss with somebody or accept some internal communication which says all this is done and all that. We need to, as an auditor, we have the responsibility to ensure that it is done in compliance with the requisite circulars of RBI. And what are the conditions? The RP shall be deemed to be implemented only if all the following conditions are met, and all the following conditions are met. The related documentation is completed by lender, change in terms of condition get duly reflected in the books of the bank, and the borrower is not in default with the lending institution as per the revised terms. Again, we need to verify these. We have seen it. Why I'm stressing on this is because we have actually seen cases where if you see the papers given to us, it is all done. But then when you get down to the conditions, the basic conditions, implementation conditions, we may find one condition which has not been complied with. Many cases they are able to later on support and give us the documentation for it. But several cases, if they are not able to substantiate, then we may need to go back and treat the account as if this dispensation was not given. And in those cases, definitely it will have to be downgraded and classified as NPA, because the borrower believes it is restructured, so they would not have repaid. And when we look at it, we find that the terms are not been complied with properly, so we will insist on a downgrade, and it will have to be downgraded. Moving on, features may allow extension of residual tenure with or without payment moratorium by a period of not more than 2 years. Important, not more than 2 years. That's going to now, many of these cases we will see, because this is a March 1st, 2020 case, and if it is around 2 years, we are talking about that account having to be, we will have the responsibility for these accounts when we go there for the March audit. Conversion of securities where aggregate, the security will have to be taken at 1 rupee, and where aggregate exposure is more than 100 crores, the ICE by a credit rating agency is required, independent credit evaluation. It's called ICE. You'll see that word used across the circular. That will have to be taken from a credit agency. And as regarding the classification and provisioning, if RP is implemented in adherence to the framework, classification of borrowers as standard may be retained. which is very important and which is really good for the borrower. So that's the best part of doing a restructuring as per this circular. And also some of the other, I did not get into some of the, I started with the COVID related because these are the important ones for the last 2 years. But if you go back a little more, you will see there have been some of the other circulars also, which is MSME restructuring or the flood in Kerala specifically. We had huge floods in 2 years, and specific flood restructuring circulars are there, etc. And in these circulars also similar dispensations have been given, wherein if the restructuring is done in compliance with the circular, then the accounts are retained in standard. Now, borrower accounts which may have slipped into NPA between invocation and implementation dates can be upgraded to standard as at the date of implementation. Closely, between invocation and implementation date. An account which was NPA before invocation date will continue as NPA. That's something we must keep in mind. You may come across cases where a branch manager may argue with you saying that we have restructured the account, sir, so we have upgraded it. Do not accept that. You must accept it only if it is an NPA, or if it has slipped into NPA between invocation and implementation. An account NPA before invocation continues as NPA. And what are the provisions required? Higher of the IRAC norms immediately before implementation, or 10% of the total debt. Lending institutions which do not sign the intercreditor agreement shall keep 20%. So certain cases where ICAI is not required, additional provision is required. An additional finance to borrowers if sanctioned even before implementation of the plan may be classified as standard asset till implementation of the plan, regardless of actual performance of the borrower. These are all, the RBI is trying to, help the borrower, and it is certainly, we've seen that, it is not just the borrower, but the banks also. Many of the banks would have declared results far worse than what we have seen if a large chunk of these were classified in 2020 or 21. Reversal of provision also, obviously, I'm not getting into that. I'm keeping a tab on my time. So if it complies with the with the circular and the payment is in accordance thereof, the provisions can be reversed. Moving on to another very important circular on 5th May, which is for both individual and small businesses as well as for MSMEs. And individuals who have availed of personal loans, excluding the personal staff and of the bank, are eligible for this. Individuals who have availed of loans where the aggregate exposure is less than 50 crore, what they say is not more than 50 crore. So 50 and less are eligible. Small businesses, including those engaged in retail and wholesale trade, other than those classified as MSME, and to whom the lending institutions have aggregate exposure of not more than 50 crores. These are the eligible ones. Again, these accounts, and this is going to, we would have seen this, those of us who would have audited last year during the course of audit, we may have seen that some of the banks completed their audit before the circular came out. So obviously the impact of this would be seen only now. Many of the branch audits, definitely we would have completed it before 5th May 21. But central audit, many of the central audits which we do, the audit committee or the board meetings would have been in the last week of May or so. And so to some extent, the impact of this circular may have been considered at the HO level in many banks. What are the invocation conditions? Lending institutions must have a board approved policy. Decision on application shall be communicated in writing within 30 days. Last date for invocation, 30th September 21. Features: compromise settlements are not permitted. This is something interesting, because if you look at the definition of restructuring and the types of restructuring permitted as per the June 19 framework, you'll see that compromise settlement is included there. But in this particular framework, compromise settlements are not permitted. Moratorium, maximum of 2 years. RP may provide for conversion of portion of debt into equity or other securities issued by the borrower, and to be implemented within 90 days from date of invocation. These are the features of this particular RP. We spoke about this. The may be retained as standard, very similar to what we had discussed in the earlier slide. So I'll skip that part. And now the convergence, because there are two frameworks. We earlier spoke about the first framework for COVID, which came out in 2020, and now in 2021. There is certain, you cannot try and say that I'm under that plus I'm under this. So to bring clarity to that, a portion has been included in the framework itself. The RF 2.0 is what this is called. The other one was called RF 1.0. This is RF 2.0. Talks about a convergence, and most importantly, that both put together, it's 2 years. The overall cap on moratorium and or extension of residual tenure granted under RF1 and RF2 combined shall only be 2 years. You cannot say RF1 gave me 2 years, RF2 gave me 2 years, so I have 4 years. No. Technically, if you read the circular, unless this convergence was not there, it could be debatable. And all of us being chartered accountants, we would closely look at where is the comma or where is the semicolon, and we would have all got into interpretation mode. But with this convergence para, there is no room for any such interpretation. And again, extension of the same for MSMEs. It needs to be classified as an MSME, registered as an MSME, Udyan and all of that, as on 31st March 21, has to be GST registered as on the date of implementation. Aggregate exposure does not exceed 50 crore and has to be standard asset as at March 21. And it should not be, obviously should not be previously restructured. Restructuring is invoked by September 30th, 90 days, provision of 10%. These are similar to what we have discussed earlier, so I'll move faster on that. And the lending institution should have a board approved policy, and classification will be standard, and accounts which may have slipped into NPA between April 1 and the date of implementation may be upgraded as standard asset as on the date of implementation. Again, a very good benefit which is given both to the borrower as well as to the bank, obviously in turn to the bank also. But what we must keep in mind is that these are accounts, many of these are going to face the heat when we go for audit this time. It certainly helped at that point in time, and country was going through its worst. But several states have gone through equally bad waves in the current year also. If you look at December or January or to some extent some part of February also, in many states situation was really bad. So we'll really have to see how these accounts are, or what is the treatment which we will have to give for these accounts when we go for the year-end audit this year. Now moving on, very important circulars which have come in 2021 November as well as 2022 February, wherein the whole prudential norm on income recognition, asset classification, etc., certain changes have been made. One important thing which we saw earlier is that in many cases the due dates were not properly mentioned. So this is something where to some extent banks had some leeway, because the due date for repayment are sometimes not specifically mentioned. Instead, some milestone is kept rather than the specific due date. Similarly, the moratorium period also, in many cases, some ambiguity is seen. But henceforth, after this clarification, now it is very clear that the exact due date for repayment of a loan, or the frequency of repayment, the breakup between principal, interest, all of this shall be clearly specified in the loan agreement itself. And the borrower has to clearly know the loan document itself must carry all the terms very clearly. And what are the terms has also been clearly mentioned in this circular. And so now there is no scope for interpretation of this or arguing that no, actually we may feel many cases that the repayment is due, but bank will argue and where they will come up with documents to say that according to sanction term, it can be argued this way, that way, and all that. And these are things which we've had to handle over time, but no longer. And we actually had an option to take a view also earlier. Now bank does not have an option, we don't have an option. So it's very clear that we cannot take a view. Similarly for moratorium also, the exact date of commencement has to be mentioned in the loan agreement, not some milestone or not some landmark on achievement of this, on ambiguity has been largely dispensed with when it comes to the circular, and read with the 15 to 22 clarification also. Now these are very important because we'll actually be seeing this for the first time. The 12/11/21 circular we had to critically analyze when we did the Q3 audits of some of the the banks that we audit, and especially when it comes to now some of the banks would classify as on a specific date. NPA classification of the 90-day now is applied on that date. 90th day may fall on say 12th December. Some banks will classify on 12th December, but most banks were doing a quarter end. So they would look at, even if it is 12th December, they would classify it on 31st December. That is also no longer allowed. Clarity has come on that. The first point is regarding specification of due date, repayment date, etc. Next is regarding the classification of both SMA and NPA, the day end process. So you do a day end process, as we all know in a bank, that from that day the clock starts ticking. So if I'm doing a day end on we are on 6th of March, 90th day from the day end process running when it ends, from that time onwards, it even talks about time of running such process, not even a day. Yeah, so that's how it goes. So the day end process, when it ends, from there everything ticks. 30th day, if there's a default, then it goes into 31st day, it goes into SMA 1, 61st day goes into SMA 2, 90th day has to be downgraded. So this is a clarity which has come, and we also had to find out that, because when you look at 31/12, 31st December, if you look at 90 days from 30th September, normally we would look at quarter end, but if you look at 30th September, then October has 31 days, November has 30 days, so 61, December has 29 days, so December 29 becomes the date when 90-day norm, by if you look at it vis-a-vis the day and running operations, December 29, and similarly, so the next cycle will start from December 30th. But in most banks, the the entry may come only on the last day of the quarter. The interest entry may come only on the last day of the quarter. So a lot of lot of discussion which happened during the course amongst auditors of large banks, and certain views were taken, and further clarification was expected on certain things, which have subsequently been clarified. When you look at the 15.2 clarification, it's because a large number of issues were taken up by auditors as well as by banks, and a lot of that has been clarified in the 15th February 22, which is obviously after the end of the Q3 audit of all banks, because results have to be declared within 45 days. So all the Q3 audits would have been over. So the impact of these clarifications we will all be seeing for the first time. All of us, irrespective of branch or central auditor, we will all be seeing these circulars for the first time when we do the audit this time. So very important that we understand what these circulars are and the intricacies of what is mentioned, and wherever necessary discussion platforms, issues which need to be taken up, let us all discuss it. And we are only in the first week of March now. If there is still some clarity, or if somebody comes up with some ambiguity in this, I'm sure we can take it up and have it clarified with the RBI and through ICAI before we actually commence the branch audit for this season. And the out of order definition also, in line with what I spoke about regarding the 90 days from the day and running, etc. Obviously, the out of order definition also requires a change to that effect. So that has also been done to ensure that it's in line with the definition of when an account needs to be classified, and these are the modifications in principle. In case of interest payment in respective term loan, an account will be classified as NPA if the interest applied at specific rests remains overdue for more than 90 days. The other out of order, etc., that we spoke about earlier are for the CC accounts, the OD accounts, etc. Term loan also has been clearly clarified in the circular. And when can it be upgraded? Again, very important change. In many places, we would have seen that the banks were arguing that if interest is repaid, the account can be upgraded. Was a view, because the downgrade happened as a result of non-payment of interest. So upgrade can also be done if that interest is repaid. Is an argument which was being taken and debated for many years. Now there is no more room for that, no ambiguity in that. It is clarified that loan accounts classified as NPA can be upgraded as standard only if entire arrears of interest and principal as on the date are paid by the area. Entire arrears, no room for interest or the quantum of default of interest, that quantum is repaid, and the banks have argued that they can upgrade it. Not possible anymore. These are important, very, very important aspects when we are going to visit branch audits. So let's keep these in mind when we are conducting the audit of the branches of the head office. Income recognition policy, I'm not really getting into this because in terms of the revenue, etc., is something that we are all aware of regarding when income can be booked or when income needs to be de-recognized is something that we know. Now, I'm rushing on that because I have another 8-10 minutes, and I thought some cases, because I've been discussing only about circulars thus far. So why does restructuring happen? Restructuring happens because an account goes bad. So I thought maybe 8-10 minutes I'll try and talk about certain practical cases which we've seen, which, as auditors, we should all keep our eyes and ears open, and we must also report on these. It's one thing to look at the circular and see whether the reschedulement or restructuring or refacement has happened in line with the circular. And it is also another, because the expectations from auditor is also increasing, and it's really good in some of the when you sit as a head office auditor, and some of the branch audit reports are so good. They talk about the reason for the stress or in certain branches. That is what is expected also. RBI, before every quarter, they have a meeting with the central auditors of the banks, and this time particularly we saw that one of the main points that they were telling us is, please take a look at the branch audit mechanism and the branch review mechanism. Because of late, what we are seeing is many of the banks are looking at centralizing the branch audit mechanism. They want the head office auditors itself to look at it. And so irrespective of whether the head office auditor is doing it or the branch auditor is doing it, there are certain aspects which we need to see when we look at the accounts. And so I've just brought that down into a few heads. The quality of appraisal per se is something we should report on. There are columns in the LFAR on all these, and most of the time, 95% of the branch audit reports, there will be nil comments. But the 4 or 5% reports which come up with these are important. As a branch auditor, we have that responsibility to report on these, and we need to talk about it. What is the branch's mechanism of identification of risk? Is there the quality, quick mortality cases? How many cases are restructured? Is CIBIL being used effectively? The enhancement of facility to unhealthy accounts, without sometimes calling it restructuring, sometimes calling it otherwise. Diversification and sectoral risk, etc. And we've seen that also, many cases. Just some examples, we saw that in one particular case, real estate sector was under real bad stress, but without looking at the proper viability, loan has been sanctioned. And then we get to know that it is somebody influential, etc. These are things which we see. Let us report on all this. CIBIL reports, discrepancy. We are seeing that you and I can access the CIBIL report, and it shows very severe defaults, but no comments on it. So branch has also not looked at it. Compliance of KYC norms not being done properly. There can be mistakes, there can be errors, there can be some degree to some extent, because of human or system-based mistakes, etc. is one. And another is gross negligence. In certain branches, what is just gross negligence. Mismatch between somebody's KYC document, you see a account holder is 25 years old, but picture is of a 75-year-old, very old man or woman's photograph is attached to the application of a 25-year-old, or vice versa. Or the application is that of a male, and then clearly a picture of a lady is stuck onto the application form. These are things which we see on random review, and that these are things, these are not being done properly. The health of the account also, this is, we see evergreening being done. An account, particularly accounts which are in SMA2 that we spoke about. It's important that as an auditor, we pick up this account which is in SMA2 as at February, but which is not an NPA as at March. Means that something has been done to recover that. Let's appreciate the efforts of the bank in ensuring that the account is not turned NPA, provided it is done in a proper manner. Provided it is not by evergreening or by giving ad hoc facility or by some sister concern credit or by giving facility to the promoter separately or and then bringing that fund back, or a fund given to an associate concern, or a new facility given to an associate concern, and the money being plowed back. So these are all not genuine credits, and it's our responsibility to see, we should not just look at the compliance of circulars. We should go one step beyond that and see whether, how is it that these accounts have been regularized? Because if that regularization is wrong, it warrants a downgrade. That's something we must keep in mind, and we have that responsibility to flag that. It may not be possible in all cases to do the downgrade at the branch level, but ideally, if possible, let us all strive to do the downgrade at the branch level itself, because it's very difficult for the central auditor to downgrade something where the branch auditor has accepted it. There's always a big tussle at the HO when that happens. So all of us are handling branch audits, and that's really the most important function. Head office auditor is only consolidating it and discussing the issues there with the management, but the all important function happens at the branch. So that's where we need to really, our resources and team have to really be trained to identify NPAs, identify cases where there are problems, etc. Especially when it comes to things like evergreening and year-end regularization. Is another case which we have seen. I'm just putting this up. I'm not really getting into it because that will require another different session altogether. But so many cases where we see year-end regularization happening, and some, what I would say is hanky-panky in regularizing accounts which are otherwise not performing well, and some odd credit will come on 30th, and when you look at it on March 29, 30, 31, some entry will be there. You look at it on April 3rd or 4th, gone. Or sometimes they will wait till the branch auditor has left, 4th, 5th, and all that, and then they remove. So if it's a bad account, verify it when you go. Maybe April 1st or 2nd, verify it, and once again verify it before you leave the branch also. Maybe we have actually seen that. When we went there, the reversal hasn't happened, but before we leave the branch, when we look at it, it has been reversed. So last day or a day before that, when we are there to discuss the report and finalize the LFAR and all that, branch level, it may be only 1 or 2 or maybe 2 or 3 accounts at best. So it may take us only another half an hour to do that. Yeah, again, these are all just some cases where health of the account is not good. So just throwing up a few instances here, which I'm sure most of us in the room here are experienced when we handle all this. But nevertheless, refresher on some of these. Fewer isolated transaction, borderline account, check purchase, very dangerous. Check purchased just before the end of the quarter, and based on that, some facility given, subsequent realization, isolated cash transactions, circuitous transactions, which means this whole sister concern, associate concern thing, ad hoc facilities. These are all various ways in which accounts are greened, and I have some examples here. For paucity of time, I'm not getting into that. And check purchases, how it has actually resulted in upgrading the account, whereas when we look at it, we find that these are not genuine, and we've had to downgrade these. Isolated cash transactions, loans to associate concerns. Large number of cases we see these loans to associate concern being routed back, sometimes through multiple branches. Same bank, in your branch you may not see it, but always it would be good, because now it's all CBS now, so we can get access. When you see that there is an associate concern, please take a look whether they have availed of facilities towards the end of the year from some other branch, at least for the bad accounts. I'm not saying it's not practical for all accounts and all that, given the 3-4 day timeline. It's not possible, but at least for the larger cases, and as far as possible, try and buy time to do the audit also, because most of these banks have their meetings only in May. So no reason why they should force the branch auditor to close by 4th, 5th, and all that. I think if we really talk to the head office and the head office auditor and all that, always you can buy some more time, at least till 9th, 10th, and all that. I think in every bank, to that extent, I'm sure there is no stress in getting these reports by April 7th or 8th, and all. It's just going to sit there till 20th in any case. So always, I think it's good to try and buy another 4-5 more days time for the branch audit, so that we can do a better job. Greening of accounts, drawing power. This is again another dicey thing where we see that the debtors and creditors, debtors and inventory is just jacked up and showed at a higher figure, and it has nothing to do with the reality. When you look at the financial balance sheet and the at the year end, the stock statements, numbers are nowhere near that. They will always say that this is given for tax purposes, so the customer has understated inventory, and all. The bank will argue with us, but we should nevertheless look at it, and if we think that the variation is substantial, we need to flag it, we must report it, and if you genuinely believe that the DP is not there, and get a stock audit done, and if the stock auditor goes there and finds it's not there, then let us go with the revised DP, and if when we look at it with the revised DP, there will be overdrawings, and if there are overdrawings beyond 90 days, let's classify it. Let's not wait for the bank to argue about all these things. Let's take a hard position there, and unless we are convinced, we need not accept their view when it comes to drawing power, because this is something which we see across the board. So many cases. I have a lot of examples here, not really getting into it. Agricultural advance, again, something very dangerous, because sometimes the advance itself, number wise, will be large number of accounts, but the outstandings will be small, so it may even slip our materiality threshold. But as a segment, let's look at it and understand whether it is being done properly, and whether the KYC is taken, and whether field officers are visiting, and whether the operations are being reviewed. What is a mechanism for agricultural advances also, because we see large cases where there are irregular operations and diversion of funds, and put together the amount will be huge. And lastly, I'll close with the pre-shipment, post-shipment also. Again, LC and many other facilities, PCL facilities, have to be looked at very carefully, because most of the time, especially when non-funded facilities are outside the balance sheet. Funded, at least we know it's all there in the balance sheet. These outside the balance sheet items have to be tracked very, very carefully, because of guarantees and all of that. Because all of this, tomorrow could result in not getting invoked. Then the whole thing turns, fresh packing facility, credit disbursed, and lot of such cases we see wherein invocation related issues which we see when we do the bank audit. So in short, yeah, it's 12:58 on my clock, and I think I've kept my time, and I'm sure there will be a lot of issues, and I do understand from the earlier sessions also what was decided is that wherever there are queries, please feel free to connect. My mail ID also I can share. It's Vivek Govind at varma.com. So VIVEK at VARMANDVARMA.com. Feel free to write to me, or you can write through SIRC. You can send your queries there, and I'm sure Naresh ji will send it back.
Yes. Yes.
Back to you, Naresh ji. Thank you once again for the opportunity and time. Thank you. I think you're on mute, Naresh ji. We can't hear you.
Thank you, Vivek, for coming and addressing on this topic.
We can hear you.
I think now I'm audible.
Audible.
I think we lost your sound again.
Audible now?
Audible, so maybe.
So thank you for addressing members on the topic. It was very nice of you to have at very short notice. Oh.
So you can continue, sir. Yeah, audible.
Am I audible now?
Yes.
Yeah. So thanks a lot for sparing your valuable time, and yeah. So thanks a lot for sparing your time on a Sunday. I'd also like to thank all the members for being there for throughout the session and interacting. I'm sure there are a lot of takeaways from the three speakers. We have had a lot of interesting topics and interesting points being shared by them. And Vivek, you also gave a very lucid and detailed presentation on the circulars, and also relating to this COVID circulars. And I'm sure most of the members are keen on having our material also. So I think I'll be sharing, and members, in case of any clarifications, doubts, or you want any discussion on this topic, you can always send a mail to sirc@ica.in. We will compile all the questions and request the respected speakers to give their views, and we will either reply back to you or put it on the SRC website. So I thank each of the speakers, CA Sarath Kumar sir, CA Ashish Makhija ji and Vivek, Krishna, Govind for being here and sharing their rich experience. All of them are experts in their domains. Thank them for sparing so much of time for the day, and also request all the members to be. There are a couple of more sessions of bank audit coming up, so we'll be in touch with you. Thanks a lot for being here today. Thank you. Thanks a lot.
Thank you so much, sir. Thank you.